Here in New York City, I'm Shauna Smith alongside Brad Smith, and this is Yahoo Finance's flagship show, The Morning Brief. Well, stock futures are falling just a bit this morning as investors await the release of Nvidia's earnings report. It's a big test for the market, and we will see whether or not the results live up to the hype.
Get pumped, folks, and investors are still betting on rate cuts. Despite cautious commentary from policymakers, we'll see if the Fed carries a more hawkish tone as the meeting minutes from the FOMC's May meeting. They're set to be released at 2 p.m. Eastern Time today. Let's get right to it with the three things that you need to know this Wednesday morning. Your roadmap for the trading day. Yahoo Finance's Jared Blickery, Brian Sazi, and Jennifer Schonberger have more.
Stock futures mixed this morning ahead of the biggest earnings report of the season, Nvidia. The AI chip darling is set to report its first quarter earnings after the bell today, offering the biggest test for Wall Street's rally. Wall Street is expecting Nvidia to report revenue and profits that rose more than 200% and 400% for the year prior as the company experiences a surge in demand for its chips amid the AI boom.
All right, inflation-battered households are saying no to putting extra stuff in their already big shopping baskets. Shares of Target are tanking after earnings missed estimates on the back of more cautious U.S. shoppers. Comparable sales dropped 3.7%, the fourth straight quarter of declines for this key metric. The company is now warning that the thriftier consumer vibe may continue throughout the summer.
And Cleveland Fed President Loretta Mester and Boston Fed President Susan Collins both said Tuesday night they need to see more evidence inflation is cooling before lowering rates. Pitcher Jay Palace said the Fed needs to see more than a quarter's worth of good inflation data before cutting rates. We'll get minutes from the Fed's policy meeting this afternoon at 2 p.m. Eastern to see whether officials still sounding a hawkish tone.
Happy Hump Day. Our top story today, the headliner of this earnings season set to report after the closing bell, Nvidia taking center stage. And expectations on Wall Street, sky high, folks. This is a stock that's up over 200% over the past 52 weeks. There you're taking a look at that one-year move.
So let's dig into why this matters so much here for the market. A lot of it has to do with simply just the size of Nvidia. When you take a look at the market cap, just around 2.3 trillion. So what exactly does that mean here for that outsized influence? Its weightings is more than 5% of the S&P 500, just around 10% of the Nasdaq 100. These are the latest calculations here compiled by our very own Jared Blickery. Then also when you take a look at the VanEck Semiconductor ETF, the weightings there just around 20%. And it is so important to the overall story for earnings, especially what we are seeing this season. Now, we've talked about technology, those mega cap names really carrying some of that growth that we have seen so far this earnings season. Let's take a look at what those expectations are, because earnings growth with Nvidia, that would be right around 23.5%, nearly 24%. Now, compare that to the earnings growth that we would see without Nvidia, and that would be just under 11% here. So really just talking about the weight of Nvidia right now and the massive influence it has here, Brad, on the broader market.
Yeah, I was looking at that stock price, as many of our viewers were as well, as we had that blown up on the screen. $953 right now per share for Nvidia. And so people may naturally ask themselves, is this company too expensive? And we were discussing that very matter actually with David Wagner from Aptus on Wealth a few days ago. And one of the huge things that he was mentioning is the shares now trading at about 37 times forward PE, which is actually the cheapest that they've been since the crypto blow up at the end of 2018, he says, on that basis, and are now even at a discount too. As you were mentioning the index, well, the Philadelphia Semiconductor Index, the SOX Index, it's even trading at a discount to that, and that hasn't been managed, that feat, since 2014. So all that considered, it's really going to come to where this forward and demand growth continues to get a lot of investors to see that realization of some of the new forward PE that has been on the move there. There you're seeing it about a little over 38 as of this morning here. So ultimately, that's going to be one of the things I'm keeping a close tab on here. I think the options AI market here as well, the options AI read on this was expecting an implied volatility or move of about 9% after this earnings report as well, too.
We will see where, I guess, in what direction the stock could potentially swing here. And then, of course, the broader market implications. Let's talk a little bit more about that, because it's not just Nvidia as to why this report matters. Whatever the company ends up saying about AI chip demand could matter for a lot more than just the tech sector. Let's bring in Yahoo Finance's Josh Schaefer. He's here to explain. And Josh, you've been looking at obviously the outsized influence that Nvidia could have on a number of sectors, including energy and utilities.
Yeah, Shauna, so we've been talking about this Nvidia story really for a year now, going back to last May is when we sort of had that blowout earnings report. And from there, we kind of looked at, okay, what are the other chip plays in AI, right? Where do we sort of go from there? And you get to a name like maybe AMD. And then we get to kind of the hyperscalers in AI, right? The companies we talk about a lot, Meta, Alphabet, Amazon, Microsoft. And then from there, we've spread all the way to what's on your screen now, which is energy. When you take a look at the amount of the companies in the energy sector mentioning AI, it went from 19% last quarter up to almost 67% in the most recent quarter. You've seen a rally in the energy sector really for the large part of this year. You've seen a rally in the utility sector for a large part of this year, and most people are not talking about either of those sectors right now without mentioning AI. And so I think it's going to be interesting when we watch sort of the market action tomorrow and moving forward. We know Jensen Huang talks a lot about demand for AI and demand for AI chips. That's a large part of this call. It's not just about the numbers. We like to talk about the numbers in Nvidia stock itself, but they have the best read on the industry and how much people are going to be looking for these chips. And then the chips, of course, when we talk about energy and utilities, it's the power that it takes to utilize these chips. And it takes a lot more power than a normal chip. And so that's where the energy utilities play has come in. And it'll be interesting to me to see, do we see any of those stocks start to trade with the AI demand story at all? Because it's certainly become a part of the narrative there.
Well, the other question too is, when does it become tough to beat consistently on some of the comps that Nvidia is going to have to face because of its own success as well? And that's one of the other kind of frames of mind. We can't state whether or not an air pocket will not happen or whether it will happen, but ultimately the timing of that is something investors have to remember.
Absolutely, Brad. And that really probably starts next quarter, right? Which you're going to get a look into tonight with the guidance for, I should say, the current quarter. So this quarter, Nvidia is still expecting 400% earnings growth. I don't think we're going to call that tough comps, right? That they're easily beating that. When you look forward to the current quarter, looking at more like 100% earnings growth. And so it's going to start slimming down. And how do people sort of accept that? Or does it also not start slimming down?
You know, Josh, I'm curious, in the conversations that you've been having with these strategists, how much from your sense is riding on this report, just in terms of the overall health of the market and some of that broader participation? Because that really has been the narrative, that the story, like you said here, just even the AI story moving beyond just these mega cap names are starting to see more participation. So how much, is it a make or break report, do you think, for the market?
No.
Yeah.
Like we want to make it like, yes, it matters a lot. Of course it matters a lot, right? Because as you guys just pointed out, even simply the weighting of Nvidia in the S&P 500 could bring the index down tomorrow to some extent, right? Like, of course, that is kind of what we're talking about here. But the overall rally at this point, we're getting pretty broad. Right? We're getting pretty broad in this rally, and there are a lot of things working right now. So I don't think an idiosyncratic story for the company is necessarily something that could totally bring down the rally, because I think it always depends on what's happening with the company, right? They have a massive amount of demand right now. If they're not able to meet all of that demand, at some point it becomes, in some ways, maybe reasonable, because how are you going to be able to create all of these chips and ship all of these chips? They're also coming out with a new chip, and that's creating sort of its own interesting narrative there. And it's sort of a company-specific thing, right? And I think that doesn't necessarily challenge the whole rally. This rally is no longer about people just pouring into Nvidia and that sending the market higher. Now, I do think if you get to a point where they were to warn about actual slowing demand or something like that, then yes, maybe you're starting to take a hit to the AI narrative and, okay, is it as big as we thought? That's a larger question. But I don't think a lot of people anticipate that to be the narrative tonight.
All right, Josh, we're going to continue to watch Nvidia as we get closer to this report later on after the close today here. We got a lot of time between now and then. And everyone after the bell today in an exclusive interview, Yahoo Finance speaking to Nvidia CEO Jensen Huang. You could find that interview at yahoofinance.com or watch it tomorrow on The Morning Brief. You don't want to miss that. Switching gears here, let's talk about the Bullseye brand, if you will. Target shares, they are getting hammered after the company's first quarter earnings report missed the bullseye by a wide mark. The retailer's chairman and CEO, Brian Cornell, saying on a call with reporters that inflation is putting a, quote, strain on the consumer wallet. Yahoo Finance's executive editor, Brian Sazi, was on that call and has the details. All right, Brian, what did we learn?
I wish I wasn't on that call, guys, because just wasn't good. But I think I'd summarize this quarter really in one word, and just to make it very simple to the average investor out there, it stunk, really through and through. The sales were down about 3.7% for Target. Walmart sales up 3.8% in the United States. I mean, the disparity between these two companies right now is simply striking. Number two, Target has really been focusing over the past year on cutting expenses. So theoretically, you would think you would see profit margins going up. Didn't really happen. I didn't see any mind-blowing profit margins from this company. Go further down the income statement, you'll see that customer traffic declined. Walmart traffic increased. Average transaction for Target down. Company also, again, for another straight quarter, didn't buy back any of its stock, despite having $9.7 billion left in a buyback authorization. I think sending the signal to investors that it's not confident in its medium-term outlook. Everywhere you looked in this Target quarter, it stunk from top to bottom. And I am surprised Target is out here reiterating its guidance. On that call with Brian Cornell and the CFO, and I believe was the chief merchandise officer, they noted that inflation is starting to slow, but they're not seeing a corresponding improvement in sales. And that is a big problem. Now, if I was still an analyst and out there visiting stores, I would essentially go out there this weekend and probably come back with a story, 10 reasons why Target is losing market share to Walmart. And I think when you go into a Target store, you could easily see Target, small section of groceries. Walmart has greatly expanded its grocery section, getting more one-stop shoppers. I can't get an oil change at Target. I can get an oil change at Walmart. And then just a third one before I would drop 7 more photos. It's that the prices at Walmart are just cheaper. Walmart has been very aggressive over the past year, chopping prices in everyday essentials, home goods, you name it. And I think that's why you're finally starting to see Target respond this week, saying it's going to cut prices on 5,000 items by the end of the summer. It has to. And what I'm worried about, how does that impact margins? And does that even gain the shopper back from Walmart?
Yes, and that's exactly what I wanted to ask you. This move here, is it too little, too late? Or do you think it could maybe help move the needle just a bit here in these coming quarters?
I think Target, bottom line, is dealing with a perception problem with American households that have been battered over the head with inflation for the better part of for almost 4 or 5 years. They don't see prices coming down. And their first thought right now is a play into Walmart's tagline: save money, live better. And it's that simple. I mean, there's something wrong here when Target is continuing to put up negative same-store sales and Walmart is blowing things out of the water in terms of same-store sales margins guidance, not only at Walmart US and Sam's Club. And I think this is a Target problem. And to your point, Shauna, I think the reality is for Target stock to start working and for Target's financials to start working and improving in the back half of the year, inflation just has to continue to slow down, and the economy has to continue to strengthen, and that's a tall order.
All right, we will continue this conversation later on in the hour. We will be speaking with Michael Lasser. He's a UBS U.S. hardline and broadline and food retail analyst. He will weigh in on these results that we're just getting out here from Target Sauce. Thanks.
Yeah, thank you.
All right, more Fed speak coming up today, reinforcing the central bank's message of higher for longer interest rates, high for longer interest rates. Now, Cleveland Fed President Loretta Mester and Boston Fed President Susan Collins both reiterating the need for further evidence of cooling inflation before the Fed feels comfortable cutting rates. Yahoo Finance's Jennifer Schomburger has a breakdown there for us. Jen.
Good morning, Shauna. That's right. Cleveland Fed President Loretta Mester and Boston Fed President Susan Collins both said Tuesday night they need to see more evidence that inflation is cooling before lowering rates. The two become the latest officials to call for holding rates higher for longer. Collins said the Fed will need to be patient, that getting inflation down will take longer than she previously thought. She thinks there's still more bite left in the pipeline with rates at current levels. While policymakers welcomed the latest consumer price data, which showed inflation easing again after a sticky first quarter, officials stressed they needed to see more evidence inflation is decisively coming back to their 2% target. Mester says she needs to see a few more months of data to show inflation is coming down before cutting rates. Separately, Tuesday, Fed Governor Christopher Waller said he needs to see several more months of good inflation data before lowering rates. These comments come after Fed Chair Jay Powell said last week the Fed needs to see more than a quarter's worth of good data to lower rates. So some differing views within the Federal Reserve on just how long rates will need to be held higher for longer. We will get more insight inside the Fed's thinking when minutes from the Fed's May policy meeting are released this afternoon. Guys.
All right, Jennifer Schomburger, thanks so much for breaking that down for us. We are just getting started here on the Morning Brief. Coming up, we will take a deeper dive into the trending tickers here on the street, earnings out from TJX, and we've also got a downgrade on Lululemon. We're going to break it all down on the other side. We'll be right back.
Let's take a look at some top trending tickers this morning. We're taking a look at shares of Lululemon. They're falling after announcing the departure of its chief product officer and saying it doesn't plan on refilling the role. The apparel brand also launching a new team made up of leadership from its merchandising and brand branches, notably a new name here for some of the investors out there. Perhaps Jonathan Chung is going to be leading that particular charge here, as this is going to be consolidated up underneath of him. This is a person that also had, kind of a seasoned professional track record over 3 decades, essentially, across brands like Gap, Pangea, I think was one of them. Merrill was in there. Levi's within there as well. well. So all of these things considered, we'll see if a lot of that is transferable to the business of stretch shoe fabrics over at Lululemon and some shoes here and there.
Yeah, I think the worry here from analysts is, excuse me, is exactly what this could potentially signal here, at least in the short term. And maybe that this is a sign of weak demand for the current products that they have, because they certainly have seen a cooling in demand of some of those hip products not too long ago. When we've been talking about Lululemon over the past 12 to 18 months, there's been so much excitement surrounding their belt bags. That excitement has certainly faded here recently over the last couple of months.
Bought 3 of those for people for Christmas.
I know, you're a little late to the trend here, Brad. But I think the question for analysts is just future changes, whether or not that is going to take a little bit longer to take place and to really happen here at Lululemon. And remember, this is a stock, we have the 1 year up on the screen right now, but year to date, shares have tremendously underperformed the broader market. And you're looking at losses here of nearly 37%, and that's versus the S&P's gains of right around 11 to 12%. So certainly we have seen Lululemon under a bit of pressure right now. Raymond James, Rick Patel, the analyst there, say that this adds a wall of worry, at least in the near term, towards Lululemon. So lots of questions just about what exactly that product line is going to potentially look like here, at least in the coming quarters.
Yeah, I mean, I was waiting for, some type of call or a title for this Evercore ISI note to be unicorn tears, no fears, or something like that. But we didn't get that. We just got chief product officer departure adds to near-term Lulu concerns. And ultimately, one of the other things that they have been concerned about, they talk about this instinct being that Lululemon's explanation that some small execution issues with small sizes, select color stockouts didn't fully explain some of the U.S. same-store sales pressures as well here. So continuing to think about the price point, especially as consumers are pushing back in specific areas of even athleisure, I think that's where Lululemon might have to see some moderation in how it puts price into the market based on the product as well here. I mean, I know for me, I go straight to that back of that store, and this is my one wealth tip of the day for folks.
Oh, I'm with you.
Here, you go straight to the back of the store, you look for that "we made too much" rack, and you say, "Load me up with some half price stuff."
Catch a lot of deals on that. I just made an order. That's
my tip of the day.
"We made too much." All right, let's talk about another retailer here on the move this morning, a trending ticker here on Yahoo Finance, and that's TJX. Shares are rising up just about 2%. The company lifting its earnings guidance for the full year, also posting a 3% jump in comp sales, seeing heightened demand from its home goods stores. So that has been a standout here, at least for this quarter. When you take a look at this off-price retailer, some of the other tidbits that we're getting from these results, many of it, they're saying the general consensus on the street that this was very much in line with expectations. Gross margin was in line with consensus, although just ahead of what the management's plan was. It does expect management to be a little bit more optimistic about their business on the conference call that's happening right now. That was the latest note out from Citi, their quick reaction to these numbers. But again, we are seeing more and more consumers trading down, hurt by these higher prices, shopping at names like TJX, like Home Goods, and clearly that is benefiting these results just a bit.
Yeah, looking for deals, no matter whether the t-shirt that actually matches the shorts that you're getting is in the home goods department or somewhere else in the store. Ultimately here, one of the huge things that this company is looking at going forward here for the quarter that they actually mentioned is off to a good start and seeing numerous opportunities for their business for the balance of the year given this environment. In the longer term, they're also excited about the potential that they see to drive customer transactions and sales. You think about those customer transactions, they were also strong in this quarter. They said they saw comp sales growth at every division entirely driven by customer transactions. So that kind of underscoring the strength of the value proposition for consumers that are trying to value hack right now by looking for deals and discounts.
All right, let's take a look at another mover here this morning. GameStop shares on the move again today. Third-party presidential candidate Robert F. Kennedy Jr. announcing that he invested $24,000 in the stock, but you're still looking at losses of just about 2.5% on X. He posted a picture saying that his administration would support, or he would support, the quote, ape retail rebellion. Yahoo Finance's Rick Newman has more on this. Rick, just give me your thoughts on this move, whether or not it really matters here with voters, and whether or not it's going to win him voters here in November.
I guess presidential candidates now have to decide whether they're pro-ape or anti-ape. I'm not really sure what to make of this. I mean, it's interesting that GameStop is not up. It looks like it's down a little bit in the pre-market trading. So it's not as if RFK Jr. is giving a boost to this stock. And he sounds like kind of a poser, doesn't he? I mean, he sounds like he looked up four of the sort of phrases you're supposed to use if you're an ape trader, a day trader, a meme stock trader. I looked up, so the question is how many day traders or meme stock traders are there? And are they actually like a political bloc that's worth trying to persuade? So I went over to Reddit, looked at the Wall Street Bets channel there. That has 16 million subscribers, but that doesn't mean all of them are in the United States. Doesn't mean they're registered voters. Who knows where they actually lived? If they don't live in swing states, it doesn't really matter. It makes me wonder if Keith Gill, aka Roaring Kitty, the main meme stock trader, if he's going to endorse a presidential candidate, and if he does, will it matter? You can imagine that RFK Jr. and maybe Trump are asking him, "Hey, how about an endorsement?" I mean, I've been thinking like a Taylor Swift endorsement would be the thing that might be, decisive in the late stages of this election. But maybe it's going to be a Roaring Kitty endorsement, or maybe we'll even have a Roaring Kitty political party that comes out of this somehow. So many interesting possibilities. Also, maybe this won't matter at all.
Rick, I struggle to conjure up some type of serious question after seeing that graphic that we just saw on screen here, but I'll do my best here. Okay, you put it back on screen, great. Ultimately, at the end of the day, when you think about this moment for RFK, and even if we know anything about what his economic policies would be that investors out there could or should have in mind as they go to the polls, do we know anything about that at this juncture?
Well, I think that question, Brad, supposes or presupposes that he might actually have a chance of winning, which most analysts think he does not. He does not have a chance of winning. The big question with RFK Jr. is if he's on the ballot in swing states, will he take more votes from Biden or more votes from Trump? And it's not entirely clear. So he's positioning himself as more of a fringy candidate here, by siding with the meme stock traders. And, they sort of don't like the system. It's these people who feel like the system is rigged, Wall Street is rigged. So I guess if he actually positions himself in that way, maybe he takes a few votes from Trump, who also kind of wants to blow up the system. But another interesting thing going on here is the Biden administration suddenly is looking more friendly to crypto traders. Not the same as meme stock traders, but kind of related. And we seem to be getting this possible ruling out of the SEC that's going to allow an Ether ETF. So it seems like people are definitely going for like the fringe investor vote here. That's how close this election is. Everybody wants every single vote.
Doing everything they can to get those votes. All right, Rick Newman, great stuff. Thanks so much.
Bye, guys.
Well, coming up, the opening bell on Wall Street, we'll take a look at how the trading day is shaping up ahead of those critical and crucial Nvidia results after the bell tonight. You've got the Dow and S&P set to open the day in the red. We'll be right back.
All right, we're about 20 seconds out from the opening bell on Wall Street. We're taking a look at the U.S. major averages, the futures right now, pointing lower for the Dow and the S&P 500. The Nasdaq futures on this Nvidia earnings day, flat, just barely to the upside right now. I'm trying to hype it. Trying to make sure we stay excited.
Yeah, and I think a lot of this action could maybe be on the sideline here until we get those results after the bell. That certainly has been at least what has been playing out so far this week. So we will say what the results are and exactly those moves then after the bell here today.
Oh man, look at these great groups ringing the opening bell today. You've got Air Joule from Montana Technologies, or in collaboration with Montana Technologies. Over at the Nasdaq, Montana Technologies X Air Joule ringing the opening bell there. And Integer, that's an easy one to pronounce. Ticker symbol ITGR, ringing the opening bell at the NYSE. All right, that's the opening bell. Let's take a look at the markets here as we open up things on the day. The Dow and the S&P 500, just as we were mentioning a moment ago, starting off the day flat, just barely to the downside, about 0.1% move in the red for both of those major averages. The Nasdaq Composite, though, trying to hold on to those gains out of the gate here right now.
Yeah, coming off a record-setting move here for the S&P, so giving back some of those recent gains. When you take a look at the movement that we're seeing within the bond market today, we will be hearing from more Fed officials here later on today. Of course, the focus is going to be on rate cuts, so we're seeing yields move up just a bit higher here today, right around 445. And you take a look at the sector action that we're seeing playing out, at least at the open. You've got technology, the lone sector in the green here today, followed closely by communication services. That's just below the flat line. On the flip side, consumer staples and materials underperforming. Jared Blickery standing by with a closer look at some of the other movement that we are seeing right here at the open in commodities markets. Jared.
That's right. We're seeing kind of a mixed board. I'm going to put the Wi-Fi interactive heat map for commodities behind me. You can see copper is actually the worst off here. I'll get to that in a second. But first, let me talk about crude oil. WTI and Brent, for that matter, too, have really traded in a pretty tight trading range over the last few weeks to a month. This is the overnight action, but let me just show you the year to date. And there you can see basically during the month of May, we've had a very, very low volatility. It looks like it wants me to talk about gold, but we'll get to that in a second. So pretty low volatility, but we are on track for the lowest close since about March. So that could generate some headlines. Everybody waiting to see what OPEC Plus is going to do in the next couple weeks. Are they going to maintain the production cuts? The problem with oil, at least if you're an oil bull, if you're not an oil bull, maybe you don't like high prices, but the problem with oil is that the producers have been able to come online and provide more supply in the U.S. and abroad pretty easily whenever there seems to be a deficit. Even the minor geopolitical skirmishes that we've had, and the major ones, have not put a dent, really that big a dent in oil prices, or I should, they haven't got them higher. So here's copper futures. I mentioned this red candle right here. That is the biggest drop in a year, but still very close to these record highs. Looks like the short squeeze is easing, but we've also seen copper futures abroad in the London exchange. Those have been pretty strong as well. I do have time for gold. Let's go back to that, and we can see gold just kind of trading in a very small range by the top end, and those are record highs from just a couple days ago. Pretty much the same case for silver. Guys?
All right, Jared Blickery, thanks so much for breaking that down here for us. Let's talk about a big theme that we are watching here at Yahoo Finance, and that's the consumer. We've gotten earnings results out this morning from Target. That follows Walmart last week and a number of other big retailers, all warning that inflation is starting to hurt and has been hurting the consumer. This coming ahead of the Fed speak that we are getting later today. Officials widely expected to strike that cautious tone that we have been hearing all week. The fact that the data isn't giving us enough evidence to, at least for the Fed, to cut rates now. The FOMC meeting minutes are also set to be released this afternoon. So here to tell us what that means for the markets, the economy, where things stand today, we want to bring in David Rosenberg. He's Rosenberg Research founder and president. David, it's good to have you. So let's just take a step back. Just give us your sense of the consumer right now, the strength of the economy, and the consumer's ability here to withstand these higher rates for longer.
Well, I think that the economy was strong in the past tense. And of course, we had 3% real GDP growth last year. And so much of that was predicated on really three things: the credit card boom, the last leg of the excess savings drawdown, all that pandemic era savings from the stimulus checks got spent. And of course, we had tremendous fiscal stimulus. I mean, imagine last year to get the 3% growth, it coincided with a 35% expansion in the fiscal deficit. It just causes your eyes to roll. But That's your story for the economy. But as we saw in the first quarter, GDP growth 1.6%, probably going to get revised down. So the economy is weakening. The data aren't supporting that we're in a recession, ... just yet. And as for the consumer, it's not contracting. However, you're seeing a major shift in behavior, much more towards frugality. You're seeing that in terms of trading down. You're seeing that in terms of what the retailers are saying, in terms of how the consumption patterns are shifting towards staples and essentials and away from big ticket discretionary items. And then when you start hearing stories of Ferraris and Lamborghinis being parked outside your local Walmart, things are even changing for the high income crowd.
Yeah, seeing a lot more Maybachs outside the Planet Fitness too. David, one of the huge things that I think we're continuing to try and get a sense of is not just the way that the consumer is defined, but also what they're doing in the near term to offset some of the stickier parts of inflation. And namely, it's going to be interesting to see in the Fed meeting minutes later on today how they're continuing to evaluate things like energy and things like home owners equivalent rent as well right now in the shelter and energy calculus of the inflationary picture too. What are you expecting there?
Yeah, well, very interesting comment because, the Atlanta Fed does us a great service. And after the CPI numbers come out, they create two series. One's called the flexible CPI, which moves with the economy and represents things that people can actually substitute away from. And then there's the sticky CPI. And that is basically things, as you had mentioned, not easy to substitute away from gasoline unless you'd rather walk than drive. And you mentioned insurance. Well, you're still going to insure your home and you're still going to have health insurance. That's been your primary source of the deviation of inflation so far this year. Rents are proving to be sticky because of the lag nature in terms of how the BLS constructs it in both the CPI and the PC deflator data. As Jay Powell had said, the rental part will disinflate more forcefully, but over time, there's just more inherent lags in that particular component. But, in terms of how are consumers responding? Well, as I said before, they are trading down. They're going more towards, private labels from brand labels. They are shifting their consumption patterns away from expensive items to cheaper items. They're really, you can see it in the data from spending on durable goods. That is really, there's no more really, all that demand has been satiated. You see that with Peloton as an example. So they're basically trading down. And that's manifests itself, I think, in something that we saw in last week's retail sales report, which is that the grocery chains are actually seeing more activity. And that's why Walmart's numbers were so strong, being such a massive food retailer, at the expense of what? Because we still have to eat, at the expense of restaurants. So all of a sudden, a lot of the stuff, the part of the YOLO spending, you only live once, and the reopening trade, all that spending on services, and especially on restaurants, because restaurants are, you don't have to eat at a restaurant, you could eat in your kitchen. And so that's something that you're starting to notice, before the consumer starts to contract. Everybody's saying, where's the recession? Where's the recession? But, the study of economics is ultimately the study of social behavior. And you're starting to see those early warning signs that people are fundamentally shifting their behavior, and this relative shift from restaurants to spending some time with the family in the kitchen and cooking at home. That's actually something that we should be keeping our eyes on.
Well, David, when you take a look, though, at the surge that we're seeing in commodities and gold and silver, even the run-up that we had seen in oil, does that suggest to you that this inflation issue, it's far from under control, or where do things then stand today?
Well, actually, everybody was saying, especially after the onset of the conflict in the Middle East, and then with Iran sending these missiles into Israel last month, that oil was supposed to be going over $100 a barrel. Where's that? Everybody, and after OPEC did their production cuts, extended them, we're supposed to have oil over $100. These are the experts on oil. So you just showed a chart before that we've fallen below $80 a barrel in WTI. Where's the inflation in that? Copper has its own idiosyncratic short squeeze situation, much like nickel did a couple of years ago. That's not really leading to a broadening out of the commodity base. So in answer to your question, I'm not saying this broad-based commodity-led inflation. You mentioned gold. Yes, gold, because the PBOC is ongoingly shifting its foreign exchange reserves from dollars into gold. India is the strongest economy in the world. Their retail demand for gold is going in a huge upward trajectory. This is just a shift in Asian consumption. One by a huge central bank, the other by consumers in the one area of the world that's growing 9%. There's no other really story there. There's no inflation story for gold. It's just what's happening in India and China. As far as the inflation is concerned, look, 100% of that deviation, everybody is just so anally retentive on the deviation in inflation in the opening months of this year. 100% of that deviation from the disinflation trend in 2023, 100% of it has come from insurance, health insurance, auto insurance, home and tenant insurance. They're not really moving with the economic cycle. I mentioned before about the Atlanta Fed. The Atlanta Fed, core sticky, which moves with the cycle and actually contains the goods and services that the Fed actually has an influence over. This year-over-year core flexible is running minus 0.3 year-over-year. It's deflating, and it's deflated now for 2 straight months. Nobody talks about it. Well, they talk about the fact that the core sticky is running at 4.5%. But by definition, sticky prices don't normally go down. Right. Sticky prices are not the things, unless the Fed wants to raise rates to 20 or 30%, how is the Fed going to have any influence over auto insurance, which has been this year's?
Yeah, when the meeting minutes drop later on today, we're going to see how they're talking about it, at least in those Federal Open Market Committee meetings. David Rosenberg Research founder and president. Thanks for the time this morning.
Pleasure. Thanks for having me on.
Coming up, Target misses the bullseye in its Q1 earnings report, but is there a reason to be optimistic in the long term? We'll talk to an analyst who has the answer on the other side of the short break.
Target heading for its biggest one-day drop that we have seen in nearly 2 years. It had been off. It's off its lows of the session right now after the retailer, though, missing its mark in its first quarter earnings report. The strain largely coming from Target's physical stores, where traffic and the number of transactions fell during the quarter. Company executives are blaming inflation, saying that higher prices are taking a toll on consumers. Here with more, we want to bring in Michael Lasser. He's an analyst with UBS covering Target. Michael, it's great to talk to you. So first, just your take on Target and why we are seeing such a different story play out from Target compared to what we heard from Walmart just a week ago.
Thanks for having me. Our take on Target is that while some of the headline numbers were light of what was expected, Target's clearly making progress. Its same-store sales was down less this quarter than it was last quarter. Plus, it showed progress on its gross margin, especially important in light of facing more difficult comparisons on the gross margin. It also noted that shrink, which is the unexplained loss of inventory, has turned the corner, and it saw a 20 basis point improvement from that product, from that area within the quarter. I don't think that this is a story of consumers who were going to one mass merchant to another. Keep in mind that Target and Walmart have very different category mixes. Target over-indexes to more discretionary goods, things like coffee makers, televisions, apparel, that all of which are under pressure right now. So that is probably weighing on Target sales. Walmart leans a bit heavier on consumable items, and it's executing at a very high level, and that's what probably driving its business. So I would not look at this as the performance of one retailer is mutually exclusive with the performance of another.
So for investors who are looking at this stock price decline on the day, should they feel comfortable then if they were to add on to or initiate a position in Target on the weakness that we're seeing?
Absolutely. This is a wonderful buying opportunity. Keep in mind that Target is still on pace to earn somewhere in the neighborhood of $9.50 this year, putting it well positioned to earn $10 next year. If that's realistic, the stock is trading right now at 14 times that number. That is just too low a multiple. Another way to think about it is Target's in a good spot to generate at least $4 billion of free cash flow this year that it can distribute to shareholders in the form of share buybacks and dividends. And if you look at that relative to its market cap, it translates to a 6% free cash flow yield. For a business of this standing and this quality, that is a very attractive valuation level. And we would advocate that investors take advantage of this short-term dip in the stock price. You will make money, in our view, over the long term.
Michael, when you take a look at some of the initiatives that Target has laid out earlier this week, we heard the news that they're lowering prices on about up to 5,000 products. Also recently announcing a Target 360. How much are those two moves, coupled with some of the other initiatives that they've done, is that going to really move the needle, help them win back that lost market share?
I think it will. The Target shopper right now is under a significant amount of pressure from the collective impact of inflation, from rising credit card debt. Target noted that 1 in 3 American consumers have maxed out on their credit cards right now. All of those suggest that Target needs to lean into value, which it's doing by these price investments. And at the same time, it's also introducing more private label products that come at a very attractive price. So those factors should drive better trends at Target, coupled with easier comparisons in the quarters ahead.
And you think and compare Target to what we're seeing in Walmart right now, and how both of these have a grocery play to try and lure consumers in and make sure that they are shopping in other aisles of the store. But is there one play that's really more well positioned at this juncture?
So the near-term momentum has to go to Walmart, and it's benefiting from traffic to its stores, traffic to its online business. It has expanded its online assortment to 420 million items online. So that makes it appeal to a broader array of customers. Target right now is thought of as more of a discretionary retailer. in areas like home and consumer electronics and sporting goods. And those are areas where the consumer is just not focused right now. Now, with that being said, there's quite a divergence in the multiples of these two stocks. We argue that they both can continue to outperform given the relative positioning of those businesses along with their valuation. So we don't think it's one or the other. We think that they both are core holdings for those who are invested in the retail sector.
Michael Lasser, UBS, U.S. Hardline and Broadline and Food.
Thanks very much for having me.
Thanks so much, Michael. Good to see you. All your markets action ahead, everyone. Stay tuned. You're watching Morning Brief. The vibe on the street today is a little less animated than usual. Pixar Animation Studios is laying off about 14% of its workforce as Disney looks to cut costs and scale back on content made for streaming. The cuts signal that Disney might turn its focus back on feature films that are released in theaters. Now, a lot of these Pixar films are also released in theaters, we should mention. Some of them have been wildly successful for Disney over the years, both in performance at the box office, but then additionally, even moreover, into merchandise as well here. We're taking a look at shares, relatively muted on this announcement here. This comes after what we had seen in wave of layoffs that Disney put in last year, but now this kind of still lingering in some of the other strategic parts of the business where Disney will need to reallocate costs in order to hit some of the targets that have become more brought to light as a result of activist campaigns putting pressure on the executive team at the company.
Yeah, I think this is just the latest iteration of Iger cutting back spending in some areas, trying to boost profitability. Clearly the goal and the priority for Disney at this point. So this move here is certainly a reversal than what we have seen over the last couple of years. We know that Disney had been using Pixar to really build up its Disney Plus customer base. They debuted 3 films, Soul, Turning Red, and Luca, specifically online in an effort to do that. And I think it did work to some extent. They've also had original series that have been a huge hit here for Disney Plus. Cars on the Road, it's one of the favorites of my boys. They love that show. It's a huge hit with young kids. Also, Doug Days, that was a series of shorts about a dog from the movie Up. So it has worked. It has worked. But I think right now, in terms of the priority and where those priorities lie, Iger's very focused on scaling back that spending. So as a result, they aren't going to be producing these original shows for Disney Plus as part of that broader restructuring here. And like you said, that's resulting in, unfortunately, layoffs for about 14% of the workforce.
Yeah, absolutely. I just had to look up Doug Days, by the way, too.
Cute.
Yeah.
Cute.
Cute dog from the movie Squirrel. Anyway, one of the other things that we're kind of continuing to track here, of course, among the broader media landscape is just where Disney is going to be able to, going forward, monetize a lot of those streaming bundles that they had talked about here. Of course, Pixar playing into that. So we'll see what more the company has to say about this and how this plays into the strategy going forward.
We certainly will. All right, Disney moving just slightly to the upside here this morning. All right, well, coming up, the latest reading on housing. Existing home sales set to be released right at the top of the hour. Plus, crypto has been surging. Anthony Scaramucci joins us here at the desk to weigh in. Plus, we will also hear from Transportation Secretary Pete Buttigieg. He joins us to discuss the latest on the travel industry. That's all coming up on Catalyst next. 10 a.m. here in New York City. I'm Shauna Smith alongside Madison Mills. Let's dive into the catalysts that are moving markets this morning.
It's Big Tech's grand finale here. Nvidia reporting its latest earnings after the bell. As goes Nvidia, so goes the market. Will the chip giant affirm market enthusiasm as the S&P is sitting near all-time highs? We're going to discuss.
Plus, Target's disappointing sales, pointing to cracks in the consumer. CEO Brian Cornell saying that inflation is straining customers' wallets. Very similar warning to what we've heard from Home Depot, Lowe's, and even some fast food companies this earnings season.
And the housing market is stalling. The latest data coming out here showing that mortgage rates are weighing on buyers and sellers. Inventory in the existing homes market remaining near record lows, keeping prices high. So when will things start to ease? We're going to unpack all of that and more. But first, we have to talk about the biggest catalyst for markets today. Of course, the AI darling Nvidia. Wall Street's got very high expectations for the chip giant's report after the close, expecting profits to rise more than 400% from a year ago. A senior portfolio manager at Catalyst Funds saying that the company would have to top estimates by 15% to avoid a sell-off. We've got Yahoo Finance anchor Josh Lipton with us to talk about this. Josh, great to have you here. I mean, this is the day we've all been waiting for. We can't stop talking about it. What are you most excited about?
I mean, you're right to say we have a lot of strategists we talk to, and this is one of those days they had marked on the calendar as a potential catalyst, because you think of the market and what's been motivating. You guys know it's decent economy, decent earnings, and this boom of interest in AI. And of course, Nvidia is the poster child of AI. What's amazing too is I am very hard pressed, and maybe you guys can think of something else. I can't think of another stock where there's this much love for the name, right? I mean, everybody is piled on the same side of the boat with Nvidia. 90% of analysts who cover this name think you should buy it. The stock is up 90% already this year. So you have these sky high expectations, and yet the strategists and analysts we talk to seem to be broadly pretty positive and optimistic that you're going to see them report another beat and raise this quarter.
Yeah, and when we talk about just how much emphasis is on this name, we just had it up on the screen just a few minutes ago. We talk about the size of Nvidia right now, its market cap, just around 2.3 trillion, I believe. It counts for about 5% of the weighting in the S&P 500, about 10% in the Nasdaq 100. If it doesn't live up to expectations, what do you think that means more broadly for the tech sector, for some of the other names that I know you've very closely tracked now for quite some time?
Well, it's not, what's interesting, it's not just the tech sector. Like our colleague Josh Schaefer had a really interesting piece, and Josh is right to note, look at the movement you've seen in some other sectors, right? You can look at utilities. Traditionally, you would move into utilities because you're getting nervous. It's time to hunker down, get defensive, buy ammo and tune-efficient utilities, right? But now it's defensive move, but it's also offense. People move into utilities because it's an AI play. So I think Schaefer is really right to say, not only are you listening to the report, but when you hear CEO Jensen Huang get on the call, depending on how he sounds on that call about what he's seeing in his business this quarter and the quarters ahead, that could have broad ripple effects across multiple sectors.
Certainly, yeah, he was right to point that out. And it's so interesting just how focused so many of these companies are on making sure that they are communicating that AI message to their investors.
Oh, even if you go public, you almost have to sprinkle some AI dust on everything.
We saw that with Reddit too. All right, Josh Lipton, great stuff. Thanks so much. Well, after the bell today, in an exclusive interview, Yahoo Finance will be speaking to Nvidia CEO Jensen Huang. You could find that interview at yahoofinance.com or watch it tomorrow on The Morning Brief. You will not want to miss that. You can also see our very own Josh Lipton, our brand new show. Congratulations, by the way. Asking for a Trend, Monday through Friday. That's at 4:30 p.m. Eastern Time. You certainly do not want to miss that. Let's turn now to some breaking news that we've got on housing. Existing home sales falling in April, down about 1.9% from the prior month. That's more than the 0.8% dip that economists had been expecting. So again, you're seeing existing home sales fall once again. This all comes back to that inventory story, Maddie, that you and I have been talking about time and time again. Simply, these homeowners are not putting their homes on the market because of higher interest rates. Because of that, we have depressed inventory levels, and that, of course, is then weighing on sales simply because the supply is not there. So not necessarily a huge surprise that we do see a drop once again here this latest month.
Absolutely, and it's interesting to point out the inventory piece as well, which I know you were mentioning, but the inventory of unsold existing homes climbing 9% from a month ago. That totals 1.2 million at the end of April, and that is the equivalent of 3 3.5 months supply, just to put that 9% number into context here. So 3.5 months of supply, that is pretty big. The question then, how does that impact home prices, and particularly not just, homes for buyers, but also for rent, because so much of that shelter component does factor into the consumer price index that the Fed looks at to suss out the rate of inflation in the U.S. It helps them decide what they're going to do with the federal funds rate. Questions about whether or not this is going to start to show up in that CPI data in the coming months here. And home prices seen their 10th consecutive month of the year-over-year price gains in April there, but the pace of price increases could start to taper off soon. That's according to the National Association of Retailers. Joining us now with his perspective, we have Logan Mohtashami, Housing Wire's lead analyst. Logan, thank you for being here. A lot of different data points in the existing home sales here, but I'm curious, what stands out to you as the single biggest data point that is driving the perspective when it comes to housing prices and supply?
Supply is growing year over year. Our weekly tracker inventory has been showing that the new listings data has been growing year over year every week. The total inventory data is growing year over year every week. The home price growth seems a little bit strong, but we have to remember last year at this time, the NAR's existing home sales prices were actually showing negative. So it's a very low comp this month, and then the next month will be the lowest comp. And then toward the second half of the year, the growth rate of pricing should cool as inventory is up year over year. New listings data is up, and also price cut percentages are slowly growing up. That'll be a positive in the sense of trying to keep housing as affordable as possible, with total active listings still near all-time lows, but the positive story is going to be that inventory will be up this year versus what we had in 2023.
Logan, why are you so confident that it's going to be up?
Naturally, 2023 was the lowest new listings data ever recorded in history. And even when mortgage rates got toward 8%, the data line didn't move down any. Last year was a historical event. Then we started to see new listings data grow. We were at extremely abnormal levels last year. So our weekly data is going to be a few months ahead of everyone else. And we've consistently seen every single week inventory grow and new listings data grow. And we're almost at the seasonality point where that data line starts to head lower. So for this year, the positive story will be more active listings, more new listings data, and now the price cut percentages will start to pick up a little bit more. We'll see this in the existing home sales reports coming down in a few months.
Well, talk to me about the aggregate data then, Logan. I'm curious if we're missing out on any weakness that could be seen under the hood here. We know, according to Zillow, that home buyers need 80% more than they did 4 years ago to purchase a home. That's according to Zillow, as I mentioned. Are you seeing that big of a hurdle coming up in the data?
Yes, because if you look at 2022, 2023, and 2024, this is the third calendar year of the lowest home sales ever. We have to take it in context we have over 158 million people working now. So we're not that far from the Great Recession lows in demand. And it shows, right? Even this recent report, we're not seeing any real growth in sales. We haven't seen it for a while. Until mortgage rates head down towards 6% and stay there, it's very hard for this housing market to grow because the majority of all buyers are mortgage buyers, and they're the ones getting impacted the most with home prices accelerating out of control, mortgage rates this high, and also now property taxes and insurance are part into the mix. So you have massive housing inflations, and we've seen it in the home sales basically trending at near all-time lows for some time now.
All right, Logan, always great to talk to you. Thanks so much for joining us here this morning. Lead analyst with Housing Wire. We appreciate it. All right, let's turn now to crypto. Both Bitcoin and Ethereum rallying this week. Investors looking to Washington, D.C., hopeful that regulation and new products potentially could expand the industry's mainstream appeal. Joining us now to lay out what's on the table for crypto in Washington is our very own Jennifer Schomburger. Jen.
Good morning, Shauna. That's right. The crypto world hopeful for some gains this week in Washington as it pushes for a new regulatory framework and approval for an Ether ETF. Today, the House set to vote for the very first time on comprehensive crypto legislation called the Financial Innovation and Technology for the 21st Century Act, or as it's known for short, FIT 21. This legislation, which House Financial Services Chair Patrick McHenry has been pushing for the better part of a year, would establish the Commodities Future and Trading Commission as the leading regulator of digital assets. There would be clear divisions for what the CFTC will regulate and what would fall under the purview of the Securities and Exchange Commission, which has vehemently cracked down on the crypto industry with a litany of enforcement actions. This legislation would also establish consumer protections and bar the sort of commingling of customer funds that played a role in the undoing of the crypto exchange FTX back in 2022. Now, Republican lawmakers say this legislation will bring clarity for the crypto industry, but most Democrats, led by House Financial Services Committee ranking member Maxine Waters, oppose the bill. Waters warns the bill would effectively deregulate most crypto by removing them from the purview of the SEC. In a rare rebuke, SEC Chair Gary Gensler put out a lengthy statement this morning on the legislation, saying, quote, it would create new regulatory gaps and undermine decades of precedent regarding the oversight of investment contracts, putting investors and capital markets at immeasurable risk. The House expected to vote on this legislation around 5 p.m. this afternoon, where it is expected to pass the chamber, largely thanks to support from Republicans and a handful of Democrats. But prospects in the Senate remain dimmer. McHenry told reporters late yesterday afternoon that he's hopeful that a strong vote tally will galvanize the Senate to take a fresh look at this legislation. Meanwhile, elsewhere here in Washington, the SEC reportedly facing a deadline of May 23rd, that's tomorrow, for approval or denial of an Ether ETF. When I asked the SEC for comment, they said, we do not comment on individual filings. Guys?
All right, Jennifer, thanks so much for breaking that down for us. Let's talk more about the crypto rally because crypto is back. Investors once again optimistic that the SEC is going to potentially approve the spot Ethereum ETF. So what's ahead and how much further maybe can this rally that we've seen in crypto go? Who better to ask than our very own Anthony Scaramucci? He's the founder of Skybridge Capital and author of the new book, From Wall Street to the White House and Back. Congratulations on the new book, Anthony.
Thank you. I brought copies for you.
Oh, thank you. We were hoping you would.
The rule is it doesn't have to go to your house, but it can't come back to mine, okay? I got too many books in the basement.
It'll come to our houses. I'm confident of that.
I've got my yearbook picture from 1982 on the front
cover.
Looking
good. You're looking good in that picture.
Takes a lot of money to airbrush a picture like that. So, because I was reading, it's sort of odd to me that we're in a state of politicization of our regulatory system. Years ago it was what is right or wrong for the country, how are we going to stimulate growth, how are we going to create transparency for investors and give investors a full understanding of the risk. Now we're like either hard right regulatory environment or hard left regulatory environment as opposed to left and right or wrong. And Gary Gensler is an example. I work with him at Goldman Sachs. He has taken the politics of this full hog, and so it's disappointing for us on Wall Street. Because years ago, and there's a great book on this, Diana Henriquez wrote a book called Taming the Street. Years ago when they created the SEC, they went to the industry, the legislators, the regulators, the administrators, and they worked together to create the system that has been very successful in the United States for 90 plus years.
Are we starting to see, though, a bit of a sea change, though, in Washington when you take a look at the fact that at least the street is a bit more optimistic that we are going to get some sort of approval? You have the House considering this legislation. You have the Senate pushing back on some of the regulation here. There does seem to be more bipartisan support here for crypto. So are we starting to see maybe that narrative change inside Washington?
I hope so. Yeah. The problem is you have people that are in their 70s and 80s. Some of them are even closing in on 90. That are running this thing, and so they really don't have a full understanding of what's going on. Mike Novogratz said something to me yesterday, which I'll share with you guys. There are 85 million people in this country that own crypto in one form or another. There are 65 million dog owners. So you have more crypto owners than you have dog owners. I mean, just imagine a politician saying, I'm anti-dog. How would that go down, okay, with the body politic? So I think the Biden administration is looking at polling data and recognizes that younger people, Hispanic community, African American community are in crypto. You guys really want to go that hard against crypto? I don't think it makes sense from a electoral perspective. And I would have predicted, and of course I get so many things wrong, and I write about how many things I've gotten wrong in my life in that book, but if you had said to me in 2023, what's going to happen presidential-wise in 2024, I would have said both candidates will be pro-crypto. Because they're not going to lose any votes being pro-crypto, but they might lose some votes, particularly from younger people being anti-crypto.
But we are seeing that both of them are pro-crypto, just to jump in here. And
the Biden administration is pro-crypto?
Well, you came on our show and said that he was previously. Do you not think that anymore?
The Biden administration.
Right.
No, I think that what I said, I hope I said it correctly. If I didn't, I got to correct myself. I said the president himself is agnostic to positive on crypto. When we talk and sit down with the members of us in the crypto community, Gary Gensler and Elizabeth Warren are decidedly anti-crypto, and he's allowed them to control the regulatory reins. That could be changing. I mean, I think that's the point, and that's why the Wall Street's optimistic about the Ethereum ETF. There could be a signal coming from the president and his team, particularly the campaign, that this may be a mistake, the direction that we're going in.
Well, do you think that the fact that we are in an election cycle, you've got Biden and Trump both making it a political football, do you think that makes the approval of the spot ETH ETF more likely?
I do. And if you had asked me that last week, because he brought me on last week, I said there's no way this ETF is going to get approved. Because it's going to open up a Pandora's box for other types of ETFs, a Solana ETF, an Avalanche ETF, et cetera. Why would those be excluded if Ethereum is included? And so I do think there's a sea change, and I think you saw it literally this week. The market was blah, and then all of a sudden we had a 10% move in stuff, 20% move in Ethereum.
So then where does that leave this, going back to what Maddie asked just a moment ago, Biden versus Trump, is one better than the other today for crypto? Sounds like it would be Trump, maybe.
I'm obviously supporting President Biden. We'll have to get into that in a second. You're asking me a specific question. I think President Trump has very good political instincts. He was anti-crypto as president. You can see tweets that he said, anti-Bitcoin, anti-crypto. He came out about 10 days ago and said he's pro-crypto now. And I think he is probably going to tug the Biden campaign into the pro-crypto camp. Okay, I think they come reluctantly. And again, the president, you're correct, agnostic on it, but it's really some of the people like that work for Gary Gensler or Elizabeth Warren.
Which has more staying power, though? Should voters be concerned about a waffling from either candidate once the election's over?
That is a good question, but I don't think so, because I think younger people like the two of you are coming into power. And those older people, I mean, I think I don't know, was Chuck Rangel like George Washington's great-grandfather or something like that? He's still in the Congress. I mean, guys, give up the reins, let younger people run this thing, and I think the younger people will modify this. And remember, the regulators did not want Uber. Go back 10, 12 years ago, regulators, legislators were fighting Uber, but you know who wanted Uber? The people wanted Uber. And thank God in a country like this that people still win out.
So let's turn our conversation a bit and talk about the big story of the day, and that is Nvidia. I'm curious to get your thoughts. Just market at current valuations. You've got lots riding on this report. There certainly has been a lot of hype about what we are going to hear and see from Nvidia after the bell. How big of a bellwether is it for the market? And what does it ultimately mean here just in terms of the larger story, the more macro story that's playing out within the markets today?
So I've said this consistently, that we own it. We like it. We like AI. Could it be overvalued? Could it be in a crowded trade? Yes, we could be. But I want to just point out to people, if you're a long-term holder, you're going to benefit from these great companies like Nvidia. You know, if you took Amazon, go back 25 years, 10 periods of time down at least 20, one period of time down 80. The very famous Jeff Bezos letter in the year 2000 when he was writing about the demolition of his stock, but yet the improvement of fundamentals. Nvidia is growing and evolving. Could it have a short-term impact on the market here? No question. Do we own it? We own it. Are we staying in it? Yes. And, you know, I just point out to people that are listening, there's a guy named Warren Buffett. He made a 70-year bet on America. Sometime in 1954, he decided, you know what, I'm getting long America. I'm getting long super high-quality companies. I'm going to take this ride with America. And I think people have to start thinking like that again. Nvidia is one of those names. I think if you hold it over the next decade, you're going to be very well rewarded.
I know a year ago we spoke and you said regarding the Fed from a macro perspective that they would declare victory around 4% inflation. We've seen them very much so not do that. They're sticking to that 2% goal. What do you think that that does for risk assets for the tech trade, including names like Nvidia?
Okay, so you're right. They are jawboning people and telling the people they're going to go to 2%. But when you really look at the data, I think they cut rates well before they get to those targets. And so I'm still in the 2, possibly 3 camp this year. Hopefully you guys will invite me back to either prove me right or wrong on that. But the reason I'm saying that is they have this debt bullet. They're staring down the barrel of a debt bullet. You don't want to get the U.S. in a situation where we're spending $1.5 to $2 trillion on interest payments. We're upside down right now. 27% of the GDP is in federal spending. 6 to 7% of it is in deficit spending. If alarm bells are not going off at the Fed, or if you're looking at the economic dashboard of the country and seeing this imbalance, this is wild deficit spending for a nation at full employment with these wage numbers.
Well, let's talk about the book because I'm curious about your thoughts on how it ties to the election. The new book from Wall Street to the White House and back here. I'm curious, what is one thing that you know from your time in the White House about President Trump that you think that voters should know heading into November?
Listen, there's 40 of us. I was with Secretary Esper this week. I was with General Milley. General Kelly's a personal friend of mine. There are 40 of us that have spoken out about the danger of Donald Trump returning to the White House. The Vice President of the United States for the 4 years prior, Mike Pence, has spoken out about this. He was on the ballot with the president. So I submit to the two of you and your viewers and listeners, if we worked at a car company and we told you the car was not manufactured properly, it was going to blow up and kill your family, are you getting in the car? If we worked at a pharmaceutical company and told you, hey, that pill's going to kill you. So you've got 40 people that were in the cabinet, sub-cabinet, assistants to the president, are telling you how dangerous he is, or telling you how unpredictable he is, how irrational the decision-making is. He's also stating publicly, he used in his advertising recently the words unified Reich. I mean, who does that in the United States? He's saying publicly that he wants to deport 15 million people. Okay, you just got to stop and think about what he's saying. He wants to go after people like you guys in the media. If you don't agree with him, he has said publicly he wants to pull FCC licenses from people that don't agree with him. He told 2 of his defense attorneys, both of which left his defense, that he wants to use the FBI as the Gestapo. Now, the good news is he doesn't understand history, he doesn't read books, he doesn't even know what that word means, the Gestapo. So we got a lot of people on Wall Street that like him. They think that the short-termism of those business policies are going to help the country. But what has been great about this country is the predictabilities of the law and the subordination of all of us to the law. And the founder set up a system that said no one person could have that amount of power. And so he talks about unitary executive power, and he's got guys on his team from the Heritage Foundation but believe in that. So go read about unitary executive power and read their 1,000-page plan for what they want to do for America, and it's going to make America different than the country we grew up in. And so I will take policies from the Biden administration that I disagree with, and I'll sweat out those policies, okay, in order to get to a younger, smarter, center-right candidate.
So, Andy, I'm going to ask you, because when you take a look at the polls right now, his messaging...
That was about as diplomatic as I've ever been,
That was
by the
very...
way, okay?
We're impressed.
I mean, if this was like MSNBC, I would have probably been hitting him a lot harder. I just want to point that out.
But why is it, though, his messaging still registering with voters? And then what does that ultimately tell us about what the messaging should be at this point, maybe more so from the Biden administration?
Listen, the Biden administration is placating the hard left. You got to give President Trump credit. He's moving to the middle. He is, and even his hard right wants to ban abortion in the country. They want to stop IVF. He knows this. He's out there saying, "Hey, we got to cut that nonsense out." So, President Trump, former President Trump, tacking to the middle. The Biden administration is still placating the hard left. It's a very big mistake for them, and this is why the sentiment has changed in favor of President Trump.
All right, Anthony Scaramucci, we wish we had more time. Thanks so much for joining us
This
here.
was almost as long as my White House tenure. I'm very happy there.
Founder of Skybridge Capital,
Thank
and
you.
also congratulations on your new book, From Wall Street to the White House and Back. We really appreciate the time.
Good to be here with you guys. Thank you.
Coming up, we will be sitting down with Pete Buttigieg, U.S. Secretary of Transportation. He will talk to us about the state of travel, Boeing's manufacturing problems, and much, much more. He'll be joined by our executive editor, Brian Sazi. Don't go anywhere.
Memorial Day will be the start to a very busy summer travel season. According to AAA, the number of travelers will most likely surpass pre-pandemic levels at about 43.8 million, marking this the busiest Memorial Day holiday weekend in nearly 2 decades. U.S. Transportation Secretary Pete Buttigieg joins me now. Mr. Secretary, always nice to get a few moments with you. So we've talked a lot in the past about just chaos in America's airports because of these large crowds. What should consumers expect this weekend?
Well, we were very encouraged by last year's results. The cancellation rate for flights last year was at a 10-year low, and that included some very smooth sailing across some of the busiest travel days ever recorded last year. So what I'm looking for this year is, can the airlines and the airports of this country keep that up when we have even more travelers coming? A lot of TSA projections would suggest we're going to have the busiest summer holiday travel season ever. Memorial Day is really the launch of that. Obviously, we're pleased about what that means economically, but that's still a big challenge to the system. 44 million travelers expected by AAA, about 3 million going through TSA checkpoints on Friday alone, which we think will be the busiest day of that Memorial Day weekend as far as air travel is concerned. Definitely a good idea for travelers to allow a little extra time, make a plan, be patient. And also for air travelers, we're urging them to make sure you know your rights, because so much has changed in the last couple of years as we have launched new rules and new passenger protections to make sure that airlines take care of you, especially if you do experience some kind of disruption and the airliner is responsible.
Mr. Secretary, of course, a lot of these these airlines, in many respects, are in fact publicly traded. Delta, JetBlue, you name it. So they want to make a lot of money on a weekend like Memorial Day. They stuff the planes. But in terms of scheduling, are airlines in this country scheduling realistically?
You know, this is a big concern, especially in summer of 22, when we saw huge amounts of delays, and it seemed that the airlines just weren't prepared to service the schedules they were actually selling. So what I'm looking at now is results. The results have certainly improved, but I think one of the side benefits of the rule we just launched on automatic refunds, which says that if your flight gets canceled and you don't fly, you don't have to ask for your money back. It's just going to come to you, is that really changes the economics for airlines that might have been tempted to engage in unrealistic scheduling. Anytime there is a credible concern in our department about unrealistic scheduling, we will investigate. We've actually had some active reviews underway. And if we make a determination that that's what happened, there are consequences to that. The best way, of course, to deal with all of that is for the airlines to do the right thing in the first place. Look, we want them to succeed. We want America's airlines to succeed and thrive. We want them to do it by providing good customer service and through honest practices.
And Mr. Secretary, how much progress has been made on addressing the pilot shortage?
From my conversations with the sector, there's been definite improvement in the availability of pilots. The pay for pilots has been going up in an extraordinary way, not just for the captains of those wide-body, long-haul aircraft who can often make north of $500,000 a year, but I've been encouraged to see the entry level, the other end of that career pipeline in those regional airlines. That pay has gone through some noticeable improvements. Now, of course, raising the pay is one thing. It's taken a while for the training pipeline to catch up with that, especially because of the rigorous standards that we rightly have on what it takes to even qualify for safety reasons. But again, real improvement on the pilot front. Continuing to keep an eye on mechanics as well. That's an area where there can be a lot of tightness in that skilled labor market. And watching what's going on with flight attendants, making sure that they are well taken care of and that pipeline is strong. By the way, we're doing the same thing over on our end at the FAA, increasing the hiring of air traffic controllers. I was just in Congress asking for the funding to be able to do 2,000 controllers next year on top of the 1,800 that we are hiring this year and the 1,500 that we hired last year. We finally reversed the decade-long loss in the number of air traffic controllers, or what I should say is we've stopped that trend line from going down. Now we're pushing to accelerate it going back up.
That's certainly good to hear. And of course, a lot of the pilots and flight attendants, they're on Boeing planes, Mr. Secretary. Have you been encouraged by anything this company is doing to address legacy problems it's having and seemingly new problems that continue to pop up almost every other week?
Yeah, the good news is that there has been a lot of engagement. They've taken a number of steps in response to the pressure that the FAA is putting on them, but there's still a long way to go. In a few days, we're going to see the results of the 90-day review. The administrator, Mike Whitaker, put them on a 90-day clock and said, we need to see a comprehensive plan on how you're going to get on top of these quality issues and what it's going to take to get that done. We know that there's new leadership coming in at Boeing as well. At the end of the day, it's all about the results. They're saying the right things. They're taking encouraging steps, but we need to make sure that we see it on the shop floor, that we see it in terms of the quality of the product that rolls off the line. And that's why FAA is taking this extraordinary step of not permitting them to increase their production rate until they've shown beyond a doubt that they can safely address those quality issues and increase that production in a way that's consistent with the quality that everybody expects from such an important company and producer in the United States.
Should Americans trust Boeing that they're going to get it right?
Look, I'm on a Boeing airplane every few days. I was on one yesterday. I think I'll be on one next week too. So this is personal to me as well as something I care about as a policymaker. And bottom line is FAA is not going to allow anything to go forward that they're not satisfied is safe. Sometimes that means putting extreme pressure on a player like Boeing or on the aviation sector. But it's in everybody's interest, including those companies, for safety to be beyond a shadow of a doubt. And that's the standard. Often for some of these safety engineering choices, there is a 1 billion to 1 standard, as in there has to be less than a 1 in a billion chance of failure for the FAA to be satisfied. And that is what has made flying on a commercial airliner in America by far the safest form of transportation. A lot of work is going to go into keeping it that way.
And of course, Mr. Secretary, and lastly, we saw that ship move out of the that crashed into the Francis Scott Key Bridge this week, a positive development. What steps is the administration taking to protect and improve the nation's bridges?
Really encouraged to see that boat move. That means that that ship, I should say, move. That's a 400-foot channel opening up and a big step toward getting the full 700-foot channel up and running and get everybody back to normal at the Port of Baltimore. This has opened up a new level of attention to something that I think over the next years will be a major focus, which is what can be done to make sure things like this don't happen again. Some of the questions are about the design and protection of bridges. Some of the newest bridge designs have what are called dolphins, fenders, or even islands around their piers. But also, it's difficult to describe the level of physical force that a ship of 248 million pounds, even when it's going at about 10 miles an hour, brings with it when it has a collision like this. So the most important thing is to make sure that that can't happen in the first place. That is the focus of so much of the information coming in from NTSB. Of course, their work continues as an investigator, but we as a department are paying close attention to what that independent NTSB report is going to tell us.
Transportation Secretary Pete Buttigieg, always nice to get some time with you. Have a wonderful and safe holiday weekend. We'll talk to you soon.
Thanks, same to you.
Thank you. Madison, back over to you.
Thank you so much for that great conversation, Sazi. Really appreciate it. Moving on to our trending tickers here. More bad news for Tesla. The car maker registering only about 14,000, just shy of that number, of vehicles in Europe last month. That is according to the European Automobile Manufacturers Association. And that is down 2.3% year over year. This is Tesla's worst monthly showing in Europe since January of 2023. So that is a 15-month low and a slow start to the quarter in Europe. Elon Musk saying that things are expected to pick up in Q2. Obviously, he's going to say that. But under 14,000 vehicles is really low, particularly when you look at the context here, Shauna, because overall we saw a 14% rise in the month for battery EVs. So it's looking like it's an idiosyncratic issue specific to Tesla, which is a really negative signal for the brand in terms of sales.
Yeah, and Maddie, I think that's so critical to point out. It's also very similar to what we're seeing play out over in China when you take a look at falling sales there in Shanghai, whereas it's a bit of a contrast to what is happening with the broader EV industry there. And going back to what Musk had said on the earnings call just last month, he was trying to reassure investors right now, saying that yes, there have been some issues when you talk about the Red Sea disruptions, when you talk about the fires that played out at one of its plants in Germany, that was largely going to be in the past, and he thinks that demand will then return, sales are going to get a boost. So when you get updates like this, obviously that's in contrast to what we heard from Musk not too long ago. It's also important to point out that there has been some changes, some dialing back of subsidies, EV subsidies in Europe, specifically what is going on in Sweden and in Germany. So that, of course, probably weighing on sales just a bit, and that would be more overall for the industry, not so much Tesla specific. But I think this is a trend worth watching, right? When you take into account what is happening overseas, even when you take into account what is happening here, you have consumers under a bit of pressure, pulling back on those larger ticket items here, those big discretionary purchases. EVs, the pickup in EVs, the adoption rate, not nearly, yes, it is still growing, obviously, but not nearly at the rates that the industry had initially forecasted. So it looks like it could be maybe a little bit longer in order for Tesla and some of its other peers within the industry to regain some of that lost momentum that we have seen. But yes, especially what's going on over in Europe and even in China, it seems to be more of a Tesla-specific problem rather than an industry-wide problem.
Yeah, you mentioned Germany, those registrations down 32% for Tesla, the rest of the industry looking flat there. All right, well, coming up, does Nvidia have enough juice to push investor optimism to the next level? We'll speak to a strategist about the chip giant's impact on markets right after the break. Nvidia already hitting a fresh record high this week ahead of its earnings, while the VIX closed at its lowest level in 5 years. So volatility is low, major indices hovering near record highs. Could Nvidia be the fuel for the next wave of optimism in the market? Here to break it down for us, we have Venu Krishna. He is Barclays head of U.S. equity strategy, and he joins us here in studio. It's great to speak with you. Thank you for coming in.
Thank you for having me.
Talk to me about the signal that Nvidia's earnings could have for the rest of the market and what folks should be looking at within the earnings and just more broadly as a signal for where the market might be heading.
Listen, Nvidia's earnings are very important because in general, if you look at what has been critical to S&P's rise, it's been big tech, and Nvidia is a critical component, probably the most important component of that subgroup of just 6 stocks. And if you look at even, for example, what the market is pricing in the options market, for example, it's unbelievable that the 3 most things which the market cares about right now is the CPI print, followed by Nvidia earnings, and then the non-farm payrolls over the next month. So that just tells you how important Nvidia also is in the big scheme of things, right? But that said, I think at least in the options market, it's pricing less of an upside for Nvidia in this earnings compared to the last earnings. But remember, this is a 2.3 trillion plus stock. Yeah.
What does that then tell us just about future earnings growth and what exactly that is going to look like? If we're starting to see it slow just a little bit, obviously Nvidia has certainly been an outlier in terms of the tremendous growth, astronomical growth that they had seen over the last 4 quarters. But what does that tell us? Just maybe, will we start to see more of this return to normalization? And what does that ultimately then mean for the broader market as well?
So I would say to some extent, you're already seeing that, right? Mm-hmm. If I look at big tech as a group and you look at the extent to which the earnings surprises have been happening in the last few quarters, they've been coming down. So if you go 2 quarters ago, it was almost 14+%. Then last quarter is about 8.5%. So now it's inching lower. That's not because they're not doing well. It's because a lot of the upside and optimism is getting baked into analysts' earnings estimates, right? So to your point, what it does mean that going forward, the ability of these drivers of the market to continue to surprise and raise gets more challenging, right? So we do think that going forward, it does get incrementally challenging, but it's also a fact that over the next probably call it 2 to 4 quarters, the visibility is quite high, including for Nvidia. So when we talk to our fundamental analysts, they're fairly confident. Where it starts getting a little blurred is when you start going a year from now, what is the end state? That is still unknown because of the torrid pace at which it's been growing.
What would, that's really interesting to me. What is going to help us inform what our market is looking like a year from now the most? I know you talked through a couple of different things like CPI, Nvidia earnings, payrolls being big catalysts for the market.
Right.
Which of those is the biggest thing that you think will help us understand a year from today?
Yeah, I think one thing certainly is the CPI number, and I wouldn't just put it directly on CPI. Right now, the equity market's sensitivity to CPI prints is the most negative it's been in 25 years, right? So in other words, the market does care a lot. And I think one of the channels in which it's going to percolate into the equity market is through the rates market. So if the 10-year treasury curve starts moving the wrong direction, that is, it's come down recently, it starts going up. And especially once it starts getting closer to the 5% threshold, you can see the equity market getting a lot more antsy, right? So that's one. The other thing I think which is very important to the equity market is fundamentals actually are improving, right? That's what Q1 showed, which is a very, very healthy sign. But the expected broadening has been just about incremental. So I think what one would have liked to see is the broadening outside of tech, especially big tech, indeed happening, and is it gaining pace? So there's some very early green shoots of that, but I think a lot more needs to happen to get comfort around that level, because we've been dragged up by big tech quite substantially thus far.
Going back to what you just said a minute ago, the action that we're seeing in the bond market, we are coming down just a bit, but if we were to go back to those 5% levels, I guess what readings in the inflation print would cause it? Would it need to come in much hotter than expected? Or even if we stay around the current level that we have been hovering around. We did see a bit of improvement here, but the elevated levels that we are still hovering around, is that going to be enough to really put some more fear back into the market when it comes to inflation?
So one of the interesting things on CPI readings is that in fact, the surprises have been coming down, right? And so that's good news. In other words, most of the inflation forecasters are broadly in line with expectations, right? So nothing is surprising us. So the surprise will come if it goes up a lot more. So it's debatable what the number is, but I would argue that a 1% threshold around expectations, that's a pretty wide one for inflation, can be thought of in some ways as being reasonable. If it goes above that, then the market is going to fall. If it goes below that, then probably there's more optimism that potentially rates can get cut, right? So I think that's what it is, because even though inflation, the big part of inflation battle in my mind has kind of been won, because remember core PCE, which is what the Fed cares about, has come down from around 5.6% at the peak to around now 2.8, 2.9% level. But if you look at the 4-month CPI, it is annualizing 4% right now, core PCE. So I think we are in an interesting situation where inflation is somewhat sticky. But I think for equity markets to work, inflation doesn't need to have come down quite sharply from here, because the market has handled it quite well thus far. But any risk of rates being increased or rates actually going up, rates increased by the Fed, is definitely a negative.
It's that last leg of the marathon that's always the hardest, right? Venu, thank you so much for joining us and coming in studio. We really appreciate it so much.
You're welcome.
That was Venu Krishna. He is Barclays Head of U.S. Equity Strategy, joining us in studio. Now, China is signaling a 25% tariff on imported cars. This follows Washington's announcement of tariffs on China and could be the first sign of a tit-for-tat that will increase between the nations. For more on this development, we have our very own Akiko Fujita for more. Akiko, what are you looking at here?
Yeah, Maddie, you pointed to the timing of this. No coincidence that reports of a potential tariff on goods coming into China could be ramped up just 1 week after President Biden announced a steep increase in tariffs, particularly around Chinese EVs. Now the deputy director of China's Automotive Strategy and Policy Research Center is publicly calling for an increase in tariffs for cars imported into China. Right now, that rate's at 15%. He wants that to increase to 25%. Now, the question is, how significant of an impact will this be when you consider where cars are manufactured? China is the largest manufacturer, and there's questions about how much of this is really going to be symbolic. Now, China's reportedly looking to raise the tax on cars with larger engines. That would largely apply to German car makers that export SUVs and sedans to China. And we saw those shares of BMW and Mercedes getting punished in European trade, down more than 2%. The deputy director here saying China imported 250,000 cars in that specific bracket last year. Compare that to the 30 million vehicles that were sold in all of China. So it's a very small portion here. Now, all of this comes as the EU wraps up its own investigation into Chinese subsidies. Preliminary tariffs are due by July 4th for that, but officials have hinted they could be announced sooner. And on the U.S. trade front, we got a clearer picture on when some of those steep increases on tariffs for Chinese goods are likely to take effect. The USTR's office saying today those for Chinese imports, including EV batteries, computer chips, and medical products, are set to take effect on August 1st. Guys?
All right, Akiko, thank you so much for bringing that reporting to us. Really appreciate it. Well, Target's disappointing earnings report this morning saw sales fall 3% year over year. This is yet another example of consumers pulling back on certain discretionary items. Target's report comes after Walmart said shoppers were trading into their stores, and Macy's reported that consumers are being more discerning in spending. For more on the pulse of the consumer, we have Jerry Storch. He is Storch Advisors CEO and former Toys R Us CEO. Jerry, thanks so much for being here with us. Obviously, you have incredible experience to bring us about what it's like to lead a retailer during difficult economic times. So I'm curious, from your perspective, does this earnings season indicate to you a potential downturn that we are about to see in the broader retail space?
I think the consumer has been slowing for some time. To some degree, this has been disguised, oddly enough, by inflation. So the government reports, for example, the sales report that just came out recently, said that sales during the month of April grew by 3.5%, 3.7%, something like that. 2.7, you look at just retail. But they don't factor out inflation. Inflation is more than the growth in retail sales. So essentially what's happening is the consumer is spending more and getting less, and they know it. So that's what's been going on. And then in an environment like that, where does the consumer spend? Well, they spend where they have to spend first. So on necessities, on food, on the core health and beauty care types of products. And so that's what's been happening. So discretionary sales are simply not happening. And Target, being a retailer who's made its name on those kind of nice to have fun products like apparel, cool apparel, electronics, home goods that are kind of fancy, kind of fun, chic, shabby, whatever. But Target's made its name in those discretionary categories. And that's not where the consumer's buying right now. Meanwhile, where they are buying, which is in these necessities I talked about, Target has just simply doesn't have a strong value perception compared to Walmart or Costco or others. And consumers saying, hey, I'm not going to pay too much for it at Target. I'm going to go to Walmart.
So, Jerry, then where does that leave this turnaround story when it comes to the fact that people simply are not going to Target, they're not spending those discretionary items? We have inflation, which remains elevated, but has improved just a bit. How long is it going to take them for this turnaround story to play out?
Well, they're doing a lot of things well, and you saw just earlier this week that they knew this, obviously, that things were tough in this area. That's why just this week they announced they're taking down prices on 5,000 items. And so they're clearly trying to project value. The problem is they aren't really set up to do it. And so, for example, Target, years ago, about 20 years ago, made a strategic blunder to basically pull out of the full service grocery business. What you have in Target right now is really a large convenience grocery store, whereas Walmart is the nation's largest real grocery store with all the departments and fresh produce and everything else that you want. And that positions Target very poorly. They can't fix that overnight. They can't suddenly sort of snap their fingers across all of these stores and have a real grocery store inside of them. And so it's kind of a backwards hypermart at Target right now, where what you have is, principle of hypermart is you go to the grocery part every week, and then you pick up some general merchandise at higher margin while you're there. Target's kind of backwards. It's you go buy general merchandise once a month, and while you're there, you pick up some low margin grocery. This is a fundamental strategic blunder that Target made about 20 years ago and puts them in very bad shape compared to Walmart. But there's a lot they can do, and they're starting to do more of that, like emphasize price more, so on and so forth. But I also have to point out, they've done this themselves on price integrity. So they've got a loyalty program that's very expensive, and so they have to raise the everyday prices in order to pay for the loyalty program. Their ads are frequently full nowadays with BOGOs, as we call them in the business. Buy one, get a sale on something else. Buy one, get a gift card discount, like on laundry products, detergent products, things like that. So this undermines price integrity. So Target's been working for some time against actually hurting their price perception. They aren't going to fix it overnight.
So, Jerry, is it too late then for Target when you take into account the moves that they're rolling out Target 360, they're cutting prices on up to 5,000 products? Is that going to move the needle, or is it too little too late here of an effort?
Well, I think it'll move the needle. They're coming from a big hole. I mean, they still are not matching their pre-pandemic performance when you look at operating margins. And so that's kind of disconcerting. When you think about Walmart, flew past those numbers a long time ago, has been just blasting off during the same period that Target is struggling. And so long ago, we can stop blaming Target's issues on supply chain difficulties from the pandemic. Remember when we all said that, it's all the same. It was never all the same. Even when both Target and Walmart were struggling, Walmart was doing much better than Target. And so now as we come out of this, Target's got to look towards the future and ask those fundamental questions. Where are we really going to stand on price? Because it's not going to work just to say, well, we're more expensive than Walmart is, and in some cases quite a bit more expensive, by the way. And you've got Aldi and people like that underpricing even more, even lower than Walmart prices. So where are we going to be on price? I don't think they've answered that overall. They're just taking sort of tactical moves to try to impact it. But they're a huge retailer. They have a great amount of consumer brand equity. People still love shopping there. So I think they have a lot to work with. So I'm not counting them out, but it's going to take a while. I would say they did sort of say that their guidance said sales for this current quarter, the second quarter, will be between 0 and 2% positive same-store sales. If they're able to do that, that'll be the first time Target's had positive same-store sales in a very long time. As you know, they were negative 3% plus in this quarter when Walmart was positive 3%. So the quarter's already halfway over. So they know where they're going to come out, or at least part of it, and they're saying, oh, we might be flat now or up a little bit in this quarter. That would be significant improvement in trend. So I'm hoping that's what we're going to see.
All right, Jerry Sorch, we have to leave it there. Sorch Advisor CEO, former Toys R Us CEO. Thank you so much for joining us here and for weighing in on Target's results. Again, Target off just around nearly 7% here in early trading. Well, coming up next, we've got Wealth. It's dedicated to all of your personal finance needs. Brad Smith, he has you for the next hour. Manny and I will see you tomorrow. Stay tuned.
Welcome to Wealth. I'm Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, tools, tips, and tricks that you need to grow your money. And we've got an action-packed one here for you today. On today's show, housing hurdles. We're going to discuss the latest housing and rental data and how it could affect your wallet. And President Biden is forgiving another nearly $8 billion in student debt. Do you qualify? It's the big question. You'll find out. Plus, ahead of Nvidia's big earnings report, we're going to simplify it all for you and tell you why it's such a big deal for Wall Street. All that and much more, but first, let's kick off the show taking a look at the consumer. You, Target is out with its first quarter earnings report today, and it didn't impress Wall Street. The company's executives citing inflation as a big reason for a decline in traffic and transactions. And meanwhile, you'll remember rival Walmart reported last week, and they said despite an inflation-strapped consumer, shoppers are looking for value. We want to dig into what these reports from the two biggest U.S. retailers say about the consumer. And here with more in the details, we've got Yahoo Finance's Brooke DePalma here. So, Brooke, let's break it down.
Yeah, good morning, Brad. It really is the tale of two retailers that we're seeing here. Target falling in early trading, whereas Walmart roughly flat at around the open here, and really is same-store sales from Target disappointing on the street, down roughly 3.7%. Now, just last week, we saw same-store sales from Walmart impress the street with an upside of 3.8%. What this means, consumers are going to Walmart for those value deals. They really are very impressed with the deals, the price point, and everything that Walmart has to offer. We know that they've been ramping up their assortment and certainly ramping up their offerings in recent years. Now, in addition to that, to prove that consumers are going more, take a look at these traffic numbers. We saw in the latest quarter, Target see traffic fall 1.9%, but we saw Walmart increase their foot traffic up 3.8%. Now, Walmart has largely been known to gain foot traffic over the past few years, especially post-pandemic when consumers' wallets became pinched and they saw, hey, Walmart's doing all these makeovers, all these store renovations, starting to look a lot like a Target. Where am I going to get the best bang for my buck? And they're certainly going to Walmart these days.
Certainly. And so, Brooke, how about Target's e-commerce performance here from what we're tracking and how that is ultimately comparing? What are we seeing there?
Yeah, well, if you take a close look at the two of them compared, Target did see a bit of an uptick in e-commerce, and the CEO, Brian Cornell, alluded that increase in digital sales for the first time in more than a year, I should point out, was same-day services, drive up, in-store pickup, and same-day delivery, pushing those Target e-commerce sales higher, up 1.4%. Now, Walmart also saw e-commerce sales jump 2.8%. Walmart pointing out on the call last week, value and convenience is really what consumers are looking for right here. Not only are they looking for low prices, but they want easy pickup. They want to go in and out of the store quickly, or they want it delivered to the house. And Target's starting to pick up on that. We saw them relaunch their Target Circle Rewards program back in April, and so they're certainly looking to catch on to what consumers really want these days, value and convenience as well.
Yeah, looking for a lot of convenience and same-day services too. That was cited within the earnings report. Brooke, thanks so much for breaking this down. Appreciate it. Well, Williams-Sonoma stock is on a tear this morning after their latest earnings show the company surpassing profit estimates and the guidance here. Now, this puts the kitchen and home goods company in line with its peer, Arhaus. That stock is up 23% after their earnings beat as well. Williams-Sonoma is actually down right now by about 0.3%. It was down lower, more than this, and seeing more of an outsized impact even prior to the market open. One of the huge things to remember, and kind of a three-prong approach of this company, number one, it's a gauge on some of the more high-income consumers out there, given the Williams-Sonoma brand, the Pottery Barn brand. You can even look to the West Elm and the mid-century modern forever type of trade that you would be looking at there. So all of those things considered, we're taking a look at Williams-Sonoma over the past 2 days. You see that jump originally, but now moving lower as of right now. And one of the huge things as well in the read in on this company too is that they actually saw across two of their brands decrease in the comparable sales there. So that is something investors perhaps paying a little bit more attention to, getting more color from the company as that call took place. And then additionally, just lastly here, you got to think about ultimately what they're going to do on pricing here. And this has been a company that, even as they've spoken with Yahoo Finance earlier this year, doesn't sound like, and this, as our executive producer reminded us this morning, doesn't sound like they're going to be increasing prices, and they're pretty ironclad on that. So we'll see exactly how that does impact the bottom line. But at least in the outlook on the margin, they gave a little bit of a bright spot there for investors to really kind of be keying in on here as of right now. So we'll see exactly how that's able to pan out for the company. And we've also got a fresh read on the housing market. Of course, Williams-Sonoma tracking this too. Housing market this morning, sales of previously owned homes fell in the month of April as homeowners continue to face pressures of higher mortgage rates and rising prices. Yahoo Finance reporter Danny Romero has the full breakdown. Hey, Danny.
Brad, the housing market is still really frustrating right now for buyers. Sales of previously owned homes dropped 1.9% in April to a seasonally adjusted annual rate of 4.14 million units. Now, that's what the National Association of Realtors reported. Remember, these sales represents homes closed in February and March. That's when mortgage rates were hovering around that 7%. Now, home prices have not come down at all. The median sales price is about $408,000, and that's up 5.7% over the last year. Now, inventory, good news, has gone up over the past 4 months, landing at 1.2 million units. And this was the last time we saw this high was last October, Brad. And one of the reasons why we are seeing a jump in inventory could be the turnover from new sales, meaning that people who bought a new home stayed in their new home for maybe about a year or two, and so that turnover rate is actually factored into the existing home sales market. So another interesting part of this report was that first-time buyers took 33% of the sales in April, and that is the largest share since January of 2021. And like we referenced before on this show, is that millennials and Gen Zers, especially the young millennials, are saving up for that down payment later on in life, and they're just, it seems more financially feasible for this demographic. So that was really interesting of this report, that these first-time buyers really are getting more skin in this home buying game.
Well, it has a lot to do with, of course, family formation as well, and then just looking at opportunities that are out there right now, and potentially some refinancing that could come forward in the future as well from that cohort, and extremely important to the home buying situation. Also, a new report out from Realtor.com shows the cost of renting apartments is actually dropping across the country. So where can I get a deal? Where am I commuting in from?
Rent is slowing down on a yearly basis. Let's just put that on the table right now. The median price for an apartment fell to $1,700 in April. But where can you find this deal? Yeah. It's the South.
Okay, I can't
Austin, Texas comes to mind. It's down about $195, lower from September's peak of 2022. And the reason is because there's an influx of supply in that area. A lot of builders got to work during the pandemic to build apartments, so that has really added some pressure and put down some of those rent prices. Another market where you could really find a good deal is Las Vegas, Nevada. Some casino time probably. And San Francisco, California is another one. But there still remains some pressure, especially in the Midwest, like Indianapolis, Milwaukee. But overall, this is really good news for renters. But I have talked to some experts, and they are hinting that there could be some pressure ahead on rents. The fact that builders have pulled back on multifamily starts, so there might not be as much inventory being added to the market.
Well, I don't think we have a Yahoo Finance Austin, Texas bureau just yet, so it might be time to break ground there. Danny, thanks so much. Appreciate it. Well, a new report from Cars Commerce is highlighting recent shifts in the auto industry that point to some stabilization and more consumer choice across new, used, and electric vehicle sectors. Here with more, we've got Rebecca Lindland, who is the Cars Commerce Senior Director of Industry Data and Insights. Great to see you here, and thanks for hopping on the show with us, Rebecca. It has been a volatile year for autos. Is that going to be easing or normalizing here in the near term?
Well, thanks for having me on, Brad. It's been actually a volatile 5 years, frankly, for the automotive space. But we do see some signs of stabilization. So when we look at particularly month over month, when we look at year over year, we are still seeing some large swings, but we're grateful to see some stabilization here. One of the things that kind of keeps popping up and we look at and say, this is our new normal, is high car prices. So the average new car is running at about $49,000. That's up from around $37,000 in 2019. So we are seeing these huge increases. And what we're not seeing is any kind of erosion in those prices. We're coming down a little bit by a couple $100 maybe year over year, but we're not seeing the thousands of dollars that we would really need to see to get back to those pre-pandemic levels.
What does it seem in the calculus for purchasing a car right now for consumers out there that are in the market? There were times even within these past 5 years where it made more sense to purchase a new vehicle versus a used one because of the lifetime value that you would perhaps get out of that deal instead of going used. What is the kind of mix of the thought process right now?
I think that we're seeing consumers that are shopping both for new and used. There's a lot more overlap these days when it comes to pricing of used vehicles, because used vehicles have also increased by over 30%. So there's more used vehicles that are almost at parity in some cases with a new vehicle. The best thing in my mind is for a consumer to go to a site like cars.com. You can do some of the tools like payment calculators to figure out what really suits your budget. Keeping in mind that we're seeing a bit of a shortage on the used car side with newer used vehicles, because as you said, more people are keeping their car longer and fewer people are turning in their leased vehicles. So we're really seeing a shortage. We had softer sales in new car, and that's feeding into a shortage in used vehicles as well.
What are we seeing in the electric vehicle landscape? I mean, we've continued to hear from some of the major automobile manufacturers about how they've had to readjust their own timelines and ambitions for really seeing mass production equate to mass purchases and deliveries and whatnot. So what is the moderation that we're seeing there?
Yes, well, we just had Volkswagen announce that they're not going to bring their ID.7 sedan to the U.S. quite yet. So they've just announced that this morning. We are continuing to see volatility in the EV market space. And part of that is driven by, as you said, new vehicle launches coming in, really a change in strategy in many cases. But we do see a positive for consumers is we've gone from this hand-raising inventory stock. So you have to say, hey, I know I want to purchase this vehicle. I'm going to put a reservation in and buy it next year. Now, today, we actually are seeing stock, traditional inventory. You can go to a manufacturer and go to a dealership, rather, and test drive an EV that you may want to consider. And of course, there's a lot more choices. There's so much more variety in the EV space. So again, we encourage consumers to go onto the site, look and read about the new EVs that are out there, because there's a tremendous supply. We also are seeing more used EVs coming into the market, and those prices are also coming down as well. So there's a lot of volatility still when we think about the EV market, but supply is up by 40%, so there's a lot more choices out there.
Rebecca, just lastly, while we have you here, when CPI came out last week, I had posted this graphic that our Yahoo Finance team created to my Instagram story, just talking about all of the places where inflation is and isn't right now. And I got a remarkable amount of responses just about the auto insurance side of it. How is that also changing the type of vehicles that people are willing to buy into and the thought process and consideration going to sign on the dotted line for a car?
Absolutely. This again factors in. You have to look at the total cost of ownership anytime you're buying a vehicle. You have to look at things like whether, even on an EV side, is it worth charging or is it worth just paying for gas? Doing all of those types of calculations absolutely factor in your insurance. We're seeing huge swings in insurance prices. And the last thing that I want a consumer to do is to buy a car they can't afford, right? Just like in the housing that you've been talking about, you don't want to be house poor. You don't want to be car poor either. We actually recently released a survey that showed the best valued vehicles, and something like the Kia Forte, which has terrific features, great safety, retails for just over $20,000. There's affordable vehicles out there. You just need to do your research on them. And I just want consumers to know that a site like cars.com, we're here for you. We've done so much of this research for you, and we're happy to help.
Rebecca, great to speak with you here today. Thanks so much for taking the time. Rebecca Lindland, who is the Commerce Senior Director of Industry Data and Insights. Look forward to checking back in the future.
Thank you.
We've got all your markets action ahead. Stay tuned. You're watching Wealth. Student loan borrowers are probably feeling pretty cheerful this morning after President Biden announced more cancellations of student loan debt. The Biden administration was going to erase another $7.7 billion in federal student loans for 163,000 borrowers. And for more on this, I'm joined by Yahoo Finance senior columnist Rick Newman. All right, Rick, what do we know about this?
It adds to the student debt relief that Biden has been doing on a piecemeal basis since the Supreme Court last year struck down his plan to forgive up to $20,000 of student debt for most borrowers. So this has been coming out in dribs and drabs. The big picture here is the Biden administration now says they have put forward debt relief for about almost 5 million people. There are more than 40 million people who have student debt, but Biden has been going after the things he thinks he can do on a legal basis that will survive some legal challenges that are out there. So a lot of people may have sort of stopped paying attention because this is coming out in a piecemeal fashion. But what people need to do is go to studentaid.gov and look for loan forgiveness on there, and then go through the steps to find out if you qualify. In general, what Biden has been doing is this is not debt relief for people who just graduated for the most part. It tends to be targeted at people who have been paying back their loans for some period of time. And there are a whole different range of programs where you can get debt relief based on if you qualify through your income, if you've worked in the public sector, other things like that. So there are a whole range of programs. Nobody can keep track of all of them. So go to that website, studentaid.gov, and find out if you qualify.
Does this seem like it's moving the needle among voters as we get towards November? I mean, we're still, a ways off from it at this juncture, but we're closer than yesterday, Rick.
Man, I have no idea, Brad. A couple things to say about that. First, there are basically polls every day. And let's remind everybody, the polls that matter are the ones in 6 or 7 swing states that are going to decide this election. That is Georgia, North Carolina, Pennsylvania, Michigan, Wisconsin, Arizona, and Nevada. The latest polls show Trump and Biden, the two likely candidates, are very close. Trump basically has a small lead at this point, but it's still far out from the election. Even though we in the media have to talk about it all the time, a lot of voters aren't really thinking about who's going to get their vote if they happen to be undecided until September or October. So we're still a ways out, but this election, like the election in 2020, is very likely to be decided by a very small group of voters in just those handful of states. So it is very important to both candidates that they literally go after every voter they can. And I think that means we'll probably see more student debt relief coming from the Biden White House before we get to November.
All right. Rick, thanks for continuing to track this and break this down for us. Appreciate it.
See you, Brad.
See you. Well, credit card debt in the United States has never been higher, with the latest figures from the New York Fed putting total credit card debt at $1.12 trillion. That same study shows that 15% of Gen Zers have maxed out their credit cards. So how did this all happen? Analysts at the New York Fed attribute some of this to young adults who, on top of the inflationary costs that we've all been feeling, are being burdened with very high student debt. Factor in shorter credit histories and a lower credit limit, and you get more Gen Xers maxing out their cards or missing payments. To help us understand why this trend is happening and what can be done about it, we've got Nandan Sheth, who is the Splitit CEO. All right, we're going to get to your business in a moment here, Nandan, and thanks so much for hopping on with us. But you hear figures like this. What goes through your head?
Firstly, thanks for having me. The real story, Brad, is the phantom debt that's in the market today that's driven by buy now, pay later plans and programs. There's $50 billion worth of that debt that's unreported. And because it's unreported, it has a ripple effect on credit card repayments and exaggerates the situation that is certainly fueled by inflation and high interest rates.
How does this have a longer term ramification as well on the credit worthiness for a large group of a generation, if you will, that is now having some of these maxed out credit cards impact their scores?
I think it's going to have a seismic impact. We just did a survey, and it noted that 1/3 of individuals that sign up for a buy now, pay later plan do not know that they're originating a new loan. And as you know, those plans are not being reported to the credit bureaus, so it's hidden from the ecosystem. You probably also noticed today, in line with your question, that the CFPB announced that they're going to regulate buy now, pay later on par with credit cards, which tells you that we need more responsible lending in this space.
Okay, so let's go a little bit more into your business as a player within this buy now, pay later, or split it into payments type of space. What's different about Splitit versus some of the other comparable industry competitors? A lot of people might think about a Firm or a Klarna or something like that.
Very, very fine and formidable competitors. We're very different, Brad. The primary difference between us and other buy now, pay laters is we're not originating a new loan. And because we're not originating a new loan, we're using existing credit that consumers have on their credit cards. So if you try to make $1,000 purchase and you don't have enough of a credit limit, we won't approve you for the transaction. And as such, we feel that we're a lot more responsible because we're already governed by the credit card regulations. And the fact that we're not allowing consumers to what's called loan stack, I think makes our proposition a lot simpler and a lot more responsible for consumers and merchants.
And so that considered as well, what is the revenue model or even the profitability pathway look like for sustained profitability for Split It?
Yeah, so because we're not spending millions of dollars on marketing and our write-offs are significantly lower because we're not originating new loans, we have a very clear pathway to profitability. Number one, all of our installment plans are 0% to the consumer. We only charge the merchant, and the merchant offers the 0% plan to the consumer. So based on our volume, based on our trajectory, we're very confident that within a 18-month period, we'll be profitable. Number two, because our revenue model does not focus on consumer fees and hidden fees, it's much more, but it's much easier for merchants to adopt and ensure that their consumers are getting a very fair buy now, pay later program on their websites.
Nandan Sheth, who is the Split It CEO. Nandan, thanks so much for taking the time here with us today. Really appreciate it.
Thanks, Brad.
Certainly. Everyone, coming up, Ethereum or Ether, whatever you're calling it in your home, call it jump in this week after the SEC signals an ETF may be coming. We're going to explore how you can play in the crypto space with ETFs, should you so choose. We've got a segment for the crypto curious coming up. Ethereum surging this week after the Securities and Exchange Commission, known in your hood as the SEC, signals they're ready to move on an ETF approval for the currency under certain criteria. Now, this comes as Bitcoin surges to 71,000 thanks to increased spot ETF buying as part of the ETF report brought to you by Invesco QQQ. Joining me now, we've got Cynthia Murphy, VettaFi investment strategist, to break down how crypto ETFs could be or should be your next play here. All right, so for those who are curious about how to play crypto within their ETF portfolio here, what are the top considerations they should be keeping in mind, Cynthia?
Hey, Brad, there's a lot going on in this space and a lot that we didn't expect to be going on in this space this week. So, if you are a crypto enthusiast or you're interested in crypto space, obviously 2024 was the year for spot Bitcoin ETF approvals. Those products are out there, they're tried, tested, and demand has proven to be really, really robust, not only in retail channels, but also in the institutional channel, which I think surprised a lot of us. So if you want to dab into crypto as an advisor or as even retail through an ETF, those spot products are out there today. There's also futures products that have been in the market for a couple of years already. That's all good, well and done. What's at stake here now is the potential arrival of spot Ether ETF. So the next level, the next wave of crypto product in ETF wrappers. And that's what we're, in pin and needles watching. Is it going to happen this week? We were assuming it wasn't going to happen. It all came so quickly. You got to remember, it took about 10 years for regulators to be okay with spot Bitcoin ETFs. And now, 5 months in, we're talking about spot Ether ETFs. But we're watching this week whether these are going to be tools that are going to be approved for investors everywhere.
Is it immediately clear where, if we see massive inflows into crypto-specific spot ETFs, like we've seen with Bitcoin or like we're about to see potentially with Ether or Ethereum, where else in the ETF landscape is set to see perhaps some outflows as there's more of perhaps fanfare or attention that gets drummed up for the cryptocurrency touching ETFs?
I love that question, Brett, because it actually touches on something we've all been puzzling about all year, which is gold ETFs. So gold has been phenomenal, a really, really strong performer as an asset. We keep reading about central banks all over the world buying gold like crazy. That sticky inflation story is still a supporter of the space. And, everybody piling on gold for safety, for gains, and yet we don't see the demand show up in the ETFs as much as you would expect, given the performance. And one of the conversations we've been having is it because there's other options today, crypto being one of them? So it's been kind of interesting that the pursuit for alternatives in a portfolio, the diversification, which is like that risk management for, risks that we don't see, typically has gone into gold, but now crypto is emerging as an interesting other option. Same with commodities a little bit, but it's been kind of fascinating to see, where these flows end up going into.
Just lastly, while we have you here, Cynthia, copper. Copper is up over 27% this year. I mean, there's been a ton of fanfare around this, and it's precious metals, really, and then the counterparts, the gold and silver, also up this year. Is this a space that investors should look more into right now?
Yeah, metals have been a great story this year. On the copper side is that industrial metal story. I mean, copper is key to just about everything we're trying to do, from energy transition to industrial manufacturing, all sorts of things. So copper is a really, really strong metal for the future of where we're headed in terms of energy production and all of those things. So it makes sense that it's really strong, but you got to remember, things like industrial metals like copper, they're very dependent on economic growth. So we have to continue seeing GDP growth, economic activity in order for industrial metals to remain as a strong player.
Cynthia Murphy, who is the VettaFi investment strategist. Cynthia, great to see you. Thanks so much for hopping on with us.
Thanks for having me.
Certainly. Well, we haven't stopped talking about Nvidia all week, and for good reason. This afternoon, we finally get the results that investors have been waiting for from the chip giant. But why is Nvidia so important to investors and the market? Here to break it down for us, Yahoo Finance's very own Akiko Fujita. Hey, Akiko.
Hey there, Brad. You're certainly right. Nvidia has been at the heart of the AI trade, with the stock up more than 90% year to date going into these latest results. And the reason investors have been so bullish on Nvidia is because they make the most advanced chips that are used to run AI today. We are talking about chips known as graphics processing units, or GPUs, that are capable of processing many pieces of data simultaneously, and they are key to machine learning. Now, when it comes to the most advanced chips used for AI, Nvidia has a dominant position, with AMD far behind in second place. And because of that, Nvidia is seen as a bellwether on where AI demand is. All of that has led to huge gains for the company's stock. Take a look. Nvidia makes up just over 5% of the S&P 500, but it's accounted for nearly 25% of the index's returns year to date. And when it comes to earnings, Nvidia's share amounts to 23% of the S&P. And Brad, of course, a lot of investors hoping that number goes even higher with those results coming out later today.
And Akiko, we know that Nvidia makes most of their money from data centers, and then they reinvest a lot of that too. What are data centers? Why are they so important for AI? And what's the latest updates there?
So in the simplest terms, data centers provide the building blocks for our tech infrastructure. It is computing and storage resources allow for the delivery of applications we use, the data that gets stored and processed. When it comes to artificial intelligence, data centers are critical to training and deploying complex machine learning models and algorithms. Now, with that said, AI technologies require huge amounts of computational power, storage space, low latency networking to train and run AI models. And NVIDIA's graphics card are considered the most fastest and the most efficient for NVIDIA. And that's led to huge gains for the company. When you look at the revenue breakdown, 78% of their revenue now comes from data centers, and we'll see if that number holds after the bell today.
All right, we're going to be watching shares of NVDA immediately after that report drops. And Akiko, thanks so much for keeping tabs on this one for us. Appreciate it. We've got much more on wealth after the break, everyone. You're watching Yahoo Finance. 47% of Americans feel financially free, according to a Bank of America study. That's up from 42% a year ago. But when parsed by gender and race, people feel even less optimistic. I spoke to Lorna Sabia, who's the Bank of America head of retirement and workplace benefits, about this. And here's what she had to say.
The difference between men and women is actually marked. And so 58% of men feel financially well. Only 36% of women feel financially well, 36% and 35% for Black, African American, and Hispanics as well. So I'm always concerned about, yes, the top line is important, but unpacking that and really understanding the demographics of a particular company are equally important.
So how can women and people of color start to feel more financially stable? Here with me is John Hope Bryant, Operation Hope CEO. John, great to have you here in studio with us today.
Honored to be with you.
Absolutely. So let's dive into this. I mean, there were some pretty alarming statistics that really talk about the disparity between gender and ethnic groups feeling different here in their own financial preparedness. What's the first step that many groups can start to take, and where financial literacy gaps can also start to be narrowed as well?
Well, as you know, I wrote a book that's now a bestseller now called Financial Literacy for All. And I think and the biggest group buying that book are African American and people of color, which is quite inspiring. An economics and business book, you know, and I think people want to understand how stuff works now because they understand that we live in a free enterprise democracy. I found it interesting, the report from the young lady from Bank of America, because she did unpack it. And I think she unpacked it because she's a woman. And in 1972, a woman could not get a credit card. Now, she works for Bank of America, but in 1972, she wouldn't have. In 1972, she couldn't get a bank account or a credit card or get a loan without her husband co-signing it. Now, because women were involved in the economy, 25% of the economy are women. Almost $7 trillion a year are women. So if we were backwards on what we call DE&I today, or inclusion, women would not be involved in the economy. We have not brought people of color in the economy. We've not taught them the memo. This was my third book, How Free Enterprise and Capitalism Works. Mm-hmm. And as a result of that, people, they're not dumb and they're not stupid. It's what they don't know that they don't know that's killing them, but they think they know. They've confused making money with building wealth. Mm. You make money during the day. That's why we call it making a living. But we build wealth in our sleep. That's stocks, bonds. Only 18% of African Americans, last time I checked, invest in the stock market. 41% of us own a home. The number one way you build wealth in America is home ownership, compared to 75% of our mainstream counterparts. So the data is on the surface of it quite encouraging because financial fluency is increasing. But we have the first generation of people over 65 in our lifetime. Those are white, affluent baby boomers, really looking for retirement.
Right.
The people coming into the economy, 40% of America today are Black and brown. And in 10 years, this country will be a majority of minorities. But are they prepared for the economy? And as you look underneath this data, I need to read the report to tell you what it says, which is that you have these huge gaps. You have these huge lapses between those who are very comfortable, the tale of two cities, really the tale of two worlds, and people who are like, what's that, right? And we got to get people who are what's that into where am I going pretty quickly. Otherwise, in 20 years, we'll be speaking Mandarin, meaning that we won't be the leader of the free world economically, and there's never been a leader of the free world that wasn't the economic leader at the same time. Sure. Think France, think Germany, think UK. So we got a lot of work to do in 10 years to bridge the gap in this report. And it's no longer academic or anecdotal. Demographics are destiny. Sure. And now hopefully we can address a couple other issues that are sidebar to this in this interview, but this is critical data, and which is why we're in Delta Airlines, by the way, doing all the financial coaching for their employees.
Interesting. And we've spoken with Ed Bastian in the past. He's actually highlighted that as well.
He's a great guy. By the way, so when I first went to Delta, we don't have a problem. We're cool, we have Fidelity, and I said, no, they're helping your pilots and your six-figure income earners invest money. That's not what I'm talking about. Right. Pandemic hit. They had $1 billion of withdrawals, emergency withdrawals on 401k. I get a call from the head of HR saying, when can you start? Like, we're stunned by this. This was the ramp workers and the flight attendants and the people who are living from paycheck to paycheck. Right. And now those people are contributing money to their savings account. They're more financially secure. By the way, the airline is booming in profits, so you can do well and do good at the same time.
And so a lot of people right now are trying to figure out, even with an inflationary environment, how they can continue to build wealth, how they can prioritize wealth building as part of a regular practice for themselves. What is the first step that they can take with that regard right now?
Well, first of all, you got to address the thing that's addressing you. If you don't deal with your money's going to deal with you. And it's not going to deal with you in a positive way, because if you have low self-esteem and low confidence, you're going to end up using your credit card for therapy. All right. So first thing we got to do is understand that money is emotional. It's not a math class, and that we live in a free enterprise democracy. And so you got to be obsessed with financial literacy, like you were the right to vote. This is a civil rights issue of this generation. Every week, sit down, and of course, I would encourage you to take my book, sit down with your family once a week at the kitchen table, and unpack the money conversation. The lights don't come on by themselves. Yeah. The car note, the rent, everything going on in our lives. Let's talk about that so we understand where that is. Get your credit score up, because that's the cost of living. That's the cost of literally doing business. If you have an 18% auto loan in a secondary car dealership because your credit score stinks, that's not a Mercedes anymore. It's a Mercedes payments, and it's going to implode on you. Yeah. So if we can get our credit scores up at Operation Hope 54 points in 6 months, debt down $3,800, savings up $2,000 for somebody making $48,000 a year. That means now I can walk you into the bank branch. We're the only nonprofit allowed to operate out of a bank branch in U.S. history, and get the bank to say yes to you for access to capital when they were going to say no. So the issue that used to be racial, maybe in the 20th century, you're going to be declined because I don't like you. Now the computer at midnight doesn't know what race you are. Right. You get your credit score above 700, which is what we're doing, and the computer just says yes. And by the way, at prime interest rates. So become a homeowner. Don't rent as soon as possible. Get a life insurance policy when you're in good health, in your 20s and 30s. You can get $1 million policy at a few less than $100 a month, $50 a month if you're in good health. Get the earned income tax credit. If you're watching this, and somebody in your family makes $60,000 or less, the government owes you a check. Yeah. If you make $38,000 and you have 3 children, the government owes you $6,500, give or take. And it's retroactive for 3 years if you never filed. So for somebody watching this, they might have fallen off their seat, because that's almost $20,000 of free money that the government owes you as it's not a handout, it's a reward for working, called the Earned Income Tax Credit. Right. So my coaches work with you to get your budget straight. Stop going to Starbucks. I love Starbucks, but
it's a $9 latte.
Get a Keurig machine at home.
Somebody's got to cut that out after amount of time. I got to hustle to my finish here with the amount of time that we have left here, and I want to hit on a few things. Number one, tips for college grads right now. I mean, you think about the number of people that are coming out of school, massive amounts of debt, and they need tips as well as they're entering into the workforce and trying to best game out their financial future, but also their employment future too.
Yeah, I love you answer this question. If you hang around 9 broke people, you'll be the 10th. So watch your circle. Relationship capital is everything. Why am I saying that? All these folks obsessed with staying at home and working at home, because of the pandemic. I want to work from home. No. That's the generation I mentioned, the baby boomers, who are now retiring. They've already got their relationship capital. The boss already knows them. They're chilling at home doing remote work because their credentials are not being questioned. You take your rear end into the office. When everybody's trying to stay at home, you go into the office where nobody's there and walk by the boss's office 10 times a day until the boss says, look, come over here. Who are you? Like, what are you? And whatever assignment they offer you, just say yes. Build relationship capital with the boss, impress them with that job, with that assignment, and the chances of you getting a promotion are very, very high, because we deal with people. This world is about relationship capital more than anything else. So you combine the financial coaching I mentioned through Operation Hope, get your debt down, your savings up, your credit tight, credit scores so that you're financially tight, but also get your aspirations up in ways like the simple things like going into the office, finding that opportunity that nobody else is looking at. And all of a sudden you have now rising aspiration, rising income, and rising net worth. And your stress really goes down in your life.
We got to go. Only 30 seconds left. I mean, major year for elections as well. And we've seen DEI perhaps be the biggest pawn now that's resurfaced once again here. How could that change the broader economic landscape that we see here in the U.S.?
You got to have me come back, because the reality is that dividers can't win. We live in the largest economy in the world, and is a diverse economy. And the only way we're going to continue to be the leader of the free world is if everybody is involved in it, which means that shutting down DE&I programs is actually bad for business, has nothing to do with moral issues. This has to do with the fact you got to prepare people for the economy so they can contribute to it at scale. I wrote something called the Business Plan for America. People watching this can go download it. There's nothing but data. It's all math. And by the time you get to the bottom, you go, wow. I mean, to be blunt, if a black person succeeds there, even the racist wins, because when the economy grows, all boats rise. So the colors are really green now. Yeah. It's not black or white or red or blue. It's green, and so the leader who unites us and who finds a future of economic prosperity for all and repairs the ladder so we don't resent rich people, we want to be them, wins.
John Hope Bryant, Operation Hope CEO, joining us here in studio on Yahoo Finance. John, thanks so much.
My pleasure.
Appreciate it. Everyone, Melinda French Gates is one of the most influential philanthropists in the world, and she's soon stepping down from her job running the Bill and Melinda Gates Foundation to focus on her own venture capital firm. In our latest episode of Lead This Way, our own Brian Sazi had a chance to sit down with her and hear more about the vision to fund companies run by women and women of color. Take a look.
I am mostly through Pivotal Ventures using philanthropic dollars to invest in human beings who are changing the world. And I really look at 4 key sectors: technology, because it is changing our lives; politics, because that's where our policies and laws are made; finance, because that's where the power is; and then culturally, also the storytelling, because I think that helps bring society along to start to see everybody else.
Is there a guiding principle you use to help make some of these investments?
I look at who are the change makers in the world. Are they willing to work in partnership with others and in teams? Because no one person is going to change a sector. It takes lots of different vantage points. So I look for partners who are brave and bold and willing to lead with a new idea, and will they do it in partnership with others?
You can watch the full episode of Lead This Way with Melinda French Gates tomorrow during the 11 a.m. Eastern Time hour of Wealth. You don't want to miss it. We've got more Wealth after the break. Not all big ticket purchases are created equal. For example, you probably are sleeping on your $1,000 mattress much more often than you're wearing your $1,000 tuxedo. So, with consumers tightening their wallets, thinking in terms of cost per use rather than just cost could be a good way to prioritize your retail purchases. For more, we bring in Yahoo Finance contributor Ross Mack. All right, break down the decision-making process here for us, Ross.
Hey, Brad, thanks for having me. Listen, anytime we're in any time of economic uncertainty, I think I live by a philosophy, and that is save first, spend last, right? And I think it's quite evident that, we just had Target report, and when it's all said and done, right, consumers are actually feeling it, right? Consumer sentiment is slightly down when it comes to spending on discretionary items. We're seeing inflation persist for longer. And so when it comes to actually thinking about cost per use just as over cost, it's all about saying, how can I prioritize my spending, right? I think we can afford anything so as long as it's within budget. But when you're living in a world where maybe you have a little uncertainty, I think you should then say, do I actually need this? Am I going to use this? Am I buying new shoes, which I might wear only when I'm going out? Or am I buying, those undershirts and underwear and things of that sort where I'll actually get more wears out of it? But when it's all said and done, I think as we're moving forward, we have to be saying, I want to prioritize essentials over just some of those luxury items in times where, unfortunately, inflation is starting to persist and is going to be high for a lot longer. And I think as we're going to those department stores, don't fall victim to those buy now, pay laters, where I would only recommend it so as long as you're paying it back there's no interest component. If it's okay, pay it back within 3 months, 3 equal payments, maybe that's good, but I don't think we should be carrying any balance, whether it's credit card or buy now, pay later when it's interest accruing.
All right, you got me on the sneakers front. That felt like a personal attack there, Ross, but I guess racking up L's on the sneakers app is perhaps just part of my financial plan. Thanks so much.
It's a good thing when you see that you didn't get it.
Exactly. Ross, thanks so much. Appreciate it.
All right, my man.
Let's do a final check of the markets real quick here as we're taking a look at the Dow, the S&P 500, and the Nasdaq. As of right now, seeing a little bit of red on the screen as the Dow's down 0.2%, S&P 500 0.1%, Nasdaq flat, just barely to the downside there. And that's it for Wealth, everyone. I'm Brad Smith. Thanks so much for watching. Stay tuned. Market Domination with Julie Hyman and Josh Lipton coming up at 3 p.m. Eastern Time. You do not want to miss it.